5 and also question number 6. And then from there, we proceed to the mock exam. So we go straight to question number 5. And we start with question number 5A. So what are we told here? We are told in relation to company law, part A, explain the meaning of the term promoter. Part B, we are required to discuss the rules that governs the pre-incorporation contract. And number C, we are required to describe the common law duties of the promoter. So we're going to start with part A of that question. And basically what we are required to do here is to define the promoter. To define who? The promoter. Remember, this is basically something we discussed in topic number 2. And actually we say the promoter in very simple terms. This is the founder of a company. This is the founder of a company. In other terms, we said a promoter is any person who undertakes to form the company with respect to a given project and basically sets that company as a going what? As a going concern, of which we say that a promoter here does not include any person who is engaged or actually who is involved in the formation of the company in a professional capacity. Meaning that if, for example, we come together, we want to register a company, maybe at a certain point we engage maybe a lawyer to be able to assist us in reforming or basically registering that particular company. That lawyer we have engaged is not a promoter because he has been engaged. We have engaged that particular lawyer in a professional capacity, basically to assist us in registering what? The company. So therefore, a promoter does not include any person who is involved in the formation of the company at a professional what? A capacity. Maybe first of all, we can say that this is a founder of a company, a founder of what? Of the company. And still we can also say that this is any person who undertakes to do what? To form the company, to form the company with respect to a given project, with respect to a given project, with respect to a given what? A project, and set the company as a going concern, and set the company as a going what? As a going concern, as a going what? A concern. And that is basically the definition, a simple definition of the term who, or basically this particular person who is called the promoter. I think that simply what was required. Then let's move to part B of the question. And basically what was required in part B is we explain the rules which governs the pre-incorporation contract. So the rules governing what is called the pre-incorporation contract. Pre-incorporation what? Contract. Pre-incorporation contract. Pre-incorporation contract. Pre-incorporation contract. Now, remember in this case, we said that when we talk about the pre-incorporation contract, these are those particular contracts which are entered into on company's behalf before the company is registered or before the company is incorporated with the registrar of companies. In other terms, we refer to this particular contract here as the preliminary what? A contract. Any contract which is entered into by the promoters on behalf of the company, but before the company is registered with the registrar of companies is a pre-incorporation contract. Essentially, what we say is that this particular contract, as far as the company is concerned, they are null and void because they are contracts which were entered into before the company was registered. And actually, we say that until such time the company is registered with the registrar of companies, the company do not have contractual capacity. The company do not have the ability to enter into any contract. So therefore, that's what we are saying, that this particular contract, as far as the company is concerned, they are actually deemed to be null and void. They are actually deemed to be null and void. This particular contract here do not have any legal implication. If, for example, they are breached, by the end of the day, the company cannot be sued in a court of law. If the third party breaches that contract, the company cannot be able to go to a court of law, take a legal action against that particular third party. And therefore, what we see is that once the promoters have entered into this particular contract on company's behalf, then they will always be held personally liable. So if those particular contracts are breached, the company cannot be held liable, but rather the promoters, we said, are the one to be held liable for the breach of those particular contracts. So what the question was asking, and the rules which governs this particular contract. And I think we discussed on the legal provisions, which are the same with the rules. So number one, we said that this particular contract here, we said number one, they are null and void. They are null and void. Null and what? Null and void. And also unenforceable. They are null and void and unenforceable. Unenforceable. So basically what that means is that this particular contract here do not have any legal implication as far as the company is concerned. So if they are breached, the company cannot be sued, and equally the company cannot go to a court of law and basically take a legal action against the third party for the breach of those contracts. So they are null and void and also unenforceable. Number two, we say that the promoters are personally liable. Promoters are personally liable. Are personally liable for the breach of this contract, for the breach of this contract. So mean that if this particular contract are breached, automatically the company cannot be sued in a court of law. So the promoters are the one to be held personally liable for the breach of this contract. But equally in this case, recall, we talked about the various ways through which the promoters can avoid their personal liability. And actually, that is a very, very common question, whereby you can be required to explain various ways in terms of how the promoters, the founders of the company, can avoid being held personally liable for the breach of this particular contract. We talked about so many ways. Number one, we say that we can, or the promoters can enter into this contract in draft form. In draft form means that they will just negotiate those contracts on behalf of the company, but the contract will only be executed. The contract will only be performed once the company is registered. So they just negotiate the contract, but they will also agree with the third party that this is a contract we are negotiating on behalf of the company. The contract will only be executed, will only be performed once the company is registered. Number two, we said that the promoters can also avoid their personal liability by doing what? By basically including a clause in this particular contract that they can only be held liable up to the time the company is registered. Once the company has been registered with the registrar and the contract is breached, then they cannot be held personally liable. On the other hand, we say that the promoters can also do what? Can basically ensure that once the company is registered, the company enter into a new contract to substitute the pre-incorporation contract. So mean that once the company enter into a new contract with the same third party, the pre-incorporation contract between the promoters and the third party will be terminated and replaced by a new contract between the company and the same third party. And actually we say that is basically known as novation. That is known as what? Novation. So we talked about so many ways through which the promoters can actually be able to avoid their personal liability. And actually we said you need to understand, to remember those various ways through which the promoters can avoid their personal liability. Number three, the other rule which governs this particular contract, we say that the company cannot sue the third party. The company cannot sue the third party in case of the breach. In case of what? In case of the breach. So if the third party breaches this particular contract, the company cannot be able to go to a court of law, take a legal action against that particular third party. Number four, here we said that the company equally, or the third party, that is, the third party cannot sue the company, for the breach. The third party cannot sue the company for the breach. For the breach of what? For the breach of the contract. For the breach of what? Of the contract. So in case this particular contract is the breach, then you are saying that this particular third party cannot be able to do what? Cannot be able to sue the company for the breach of that particular contract. Number five, here we said that the company can do what? Can enter into a new contract. Can enter into a new contract. Contract to substitute. The pre-incorporation contract. The pre-incorporation contract through a process which is called what? Novation. Through a process called what? Novation. So the company, once registered, can enter into a new contract with the same third party, whereby the pre-incorporation contract would be terminated and basically replaced by a new contract between the company and the same third party. Also, on the other hand, we say that the members of the company cannot ratify. The members of the company cannot ratify this contract, cannot ratify this what? Cannot ratify this contract. So the members of the company, maybe once the company is registered, cannot pass a resolution ratifying this contract. So to ratify the contract means that the members cannot pass a resolution to approve that. In case maybe the contract is breached, the company can be held liable. They can't do that. The members of the company cannot pass a resolution to do what? To ratify this particular what? Contract. So therefore, those are basically some of the legal principles, or basically some of the rules which basically governs this particular contract here, which are known as the pre-incorporation contract. So let's move to the last part of that question, and we are told, describe the common law duties of the promoters. So the question here is asking about part C, common law duties of a promoter. Common law duties of who? Of a promoter. The common law duties of a promoter. Now, remember in this case, what we say is that during the formation of the company, basically we say that the promoters are expected to perform various duties. And actually we say that the duties of the promoters are basically broadly classified into two categories. Number one, we talked about the fiduciary duties. And number two, we talked about the common law duties. The common law duties. So therefore, the duties of the promoters are broadly classified into two. So the question here was asking about the common law duties. But before even we look on those common law duties, recall we said that the fiduciary duties, these are those particular duties which arises out of the fiduciary relationship which exists between the promoters and the promoters, and basically the promoters and the company to be formed. Remember, in this case, we said the promoters basically are regarded to be the trustees of the company. They are regarded to be the trustees of the company. So therefore, as a result of that fiduciary relationship, there are a number of duties which are expected from these promoters. Which are those duties? Number one, we talked about the duty to account. We say, if, for example, you're a promoter, you're given some amount of money to do a number of things on company's behalf, you must account. You must explain how you spent that particular amount of money, of which you say that accounting basically has to be honest. You must explain how you spent that particular amount of money, even necessarily support that with the necessary receipt. If you paid a number of items, you paid a number of expenses, support that with a relevant document. So then from there, we also talked about the duty of disclosure. In this case, we said that the promoters are expected basically to disclose two things. One is any secret profit. If you make a profit as a promoter, make sure you disclose that. Number two, the promoters are also expected to disclose any personal interest. If, for example, you have some personal interest in a transaction, in a contract you are entering into on company's behalf as a promoter, you need to disclose that to the other promoters. And finally, number three, we talked about the duty to act bona fide. The duty to act bona fide. We say as a promoter, anytime you are doing something on company's behalf, you must do it in the best interest of the company. You must do it in the best interest of what? Of the company, in the best interest of what? Of the company. So therefore, we talked about those three fiduciary duties, the duty to account, the duty of disclosure, and the duty to act what? Bona fide. So let's now look on these common law duties, the common law duties of promoters, the common law duties of the promoters, common law duties of promoters, common law duties of who? Of the promoters. Now, when we talk about the common law duties of the promoters, number one, we say that these are the general duties. The general duties of the promoters. So these are what? These are general duties. General duties of who? Of promoters. Of promoters during the formation of what? During the formation of the company. Formation of who? Of a company. During the formation of who? Of the company. So, and these duties, we said they include what? We said they include number one, basically to do what? To come up with the company's name. Come up with the company's what? Company's name. So it is basically the responsibility of the promoter to come up with a company's name and have it researched. And have it reserved and have it reserved. And have it what? Reserved. Now, the other duty of the promoters, the other duty of the promoters, or that is the other general duty. And I've said that these are general duties. These are general duties. So the other general duty of the promoter is basically to register the company, with the registrar of companies. So it is the responsibility of the promoters to do what? To register the company, with the registrar of companies, Number 3 is that the promoters here do have the responsibility to appoint the first directors of the company, to appoint first directors of the company. Number 4, we say that they have a responsibility to do what? To meet, or in other terms, to pay the preliminary expenses. Remember, in this case, we said preliminary expenses. These are those particular expenses which are incurred during the formation of the company. Who should pay those particular expenses? It is the founders of the company. That is the promoters. They have a responsibility to pay those particular what? To pay those particular expenses. On the other hand, we say they have a responsibility to acquire basically assets or what? Or property for use by the company. By who? By the company. So they have a responsibility to acquire property or asset for use by who? By the company. On the other hand, we say that if the company which is to be registered is a public company, the promoters do have a responsibility to prepare the prospectus. So we cannot talk about to prepare the prospectus. If the company registered, is a public company. If the company to be registered is a public company, the promoters do have that responsibility, basically to do what? To prepare a prospectus. Remember, we say that a prospectus is basically that document, or basically an invitation by the company, inviting the members of the public to do what? To subscribe the shares of the company. The shares of what? Of the company. So that particular prospectus has to be prepared by who? Has to be prepared by the promoters. The promoters have a responsibility of preparing that work, of preparing that particular prospectus. So therefore, those are basically the general duties of who? Of the promoters. And I think that is it. That what was required as far as that question is concerned. That is the question number 5. So let's move to the other question, that is question number 6. In question number 6, part A, it reads, identify the different types of meetings that may be held by a public limited company 8 months. So in that case, we require to identify, in other terms, to do what? To explain different types of meetings which may be held by a public limited company. Remember, you say that once a public limited company has been registered, has actually been formed, that company may convene, in other terms, may hold different types of meetings, different types of what? Different types of meetings. So question number 6, question number 6, part A, types of meetings that may be held, by who? By a public limited company. So types of meetings that may be held by a public limited company. So I think we talked about 5 types of meetings. 5 types of meetings. Yes, I think we talked about 5 types of meetings. Number 1, we talked about a meeting which is called AGM. The AGM, that is the annual general meeting. The annual general meeting. So remember, I said that the AGM, annual general meeting, this is a meeting which all the public limited companies are required to convene on annual basis. On annual basis, so mean that this meeting here is held on annual basis every year, that a public limited company has to convene this meeting. And actually we said that private companies are not under any obligation to convene these meetings for their members, to hold these meetings for their members. Number two, we say that these particular meetings should be held before the end of 6 months in the following financial year. Meaning that if, for example, a company is to hold maybe an AGM for 2025, that meeting actually will be held the following financial year 2026, but equally before the end of June. So it is held before the end of the 6 months in the following financial year. And actually we say that this particular meeting is for it to be convened, the members we said must be served with 21 days notice. On the other hand, we said those businesses which are transacted in this meeting, we refer to them as ordinary business. Business. And I think we were able to look on the various businesses which are transacted during the AGM. So those businesses include what? Number one, appointing the company's auditor. That is one of the ordinary business, appointing the company's auditor. Number two is electing the directors. Number three is basically a declaration of payment of dividends. The other one is what is the consideration and the adoption of the audited financial statements. And the other one is about what? Is about consideration and also confirmation of the minutes of the previous AGM. So therefore, we talked about those as the different types of businesses, ordinary businesses, which are basically transacted during what? During the AGM. The AGM. So the other type of meeting which may be held by this company is something called the EGM, extraordinary general meeting. So extraordinary general meeting, we say that this is any other meeting held other than AGM, and also what? The statutory meeting. And actually we say that this particular meeting here is convened to transact what is called the special business. When talk about the special business, we are referring to those particular businesses which cannot be transacted during the AGM. The AGM. And actually we say that this particular meeting here can be convened either by who? By the court upon application. It can also be convened by the directors. Or it can also be convened by the requisitionist. Remember, in this case, I was able to explain who are the requisitionists. The requisitionists are basically those particular members of the company who had requested the directors to convene this meeting, because we talked about certain number of members who may request the directors of the company to convene this meeting. We said once the directors have been requested to do that, they must convene the meeting within 21 days. If they fail to do that, then those members who had requested the meeting to be held, who are now known as the requisitionists, they can go ahead and basically convene that particular meeting. So the other meeting which can also be convened, in other terms held by a public company, is something called a class meeting. A class meeting. And actually we say the class meeting is a meeting of a certain class of who? Of shareholders. A certain class of who? Of shareholders. A certain class of shareholders. For example, in this case, we say that if the company has issued maybe the ordinary shares and also the preference shares, we said that the company can convene a general meeting of the ordinary shareholders, or the company can convene a general meeting of the preference shareholders. So that particular meeting is known as a class meeting. And actually we say that that particular meeting is ordinarily held by the company to approve something called the variation of a class right. Variation of the class of the class rate. When we talk about variation of the class rate, it basically means that this is a meeting which is convened by this company to do what? To approve some changes in relation to some rights affecting a certain class of shareholders. If, for example, maybe the company wants to, the directors are proposing the rate of dividend, the rate of preference dividends, maybe to be reduced from, assuming the company currently is paying 12%, the directors have proposed to reduce that rate of preference dividend, maybe from 12% to 10%. So that one has to be convened, or actually that company would be required to convene a general meeting, not a general meeting per se, but a class meeting of the preference shareholders, whereby the preference shareholders will come in and basically discuss that word issue, approve it by a special resolution. So then from there, we also talked about the other meeting which may be held. Let's talk over the board meeting. Let's talk over the board meeting. The board what? Meeting. After we say the board meeting, this is a meeting of the members of the board, is a meeting of the directors of the company. We say that this meeting may be convened anytime. There is no timeline when this meeting should be held. So it may be convened anytime, basically for the director to be able to do what? To transact a number of businesses during the board meeting. And I think also we talked about something called the statutory meeting. I hope you can be able to recall, we said statutory meeting, basically this under the new Companies Act, companies or public companies are not mandated. They do not have any responsibility to convene this meeting. But you said the new Companies Act states that any company which was formed under the repealed Companies Act, under the old Companies Act, it had not convened this particular meeting. You have to go ahead and convene that meeting. But we said under the new Companies Act, Companies Act of 2015, public companies are not under any obligation to do what? To hold that meeting. In other terms, any company which is registered in accordance with the Companies Act of 2015, that company do not have a responsibility to do what? To convene that meeting. So therefore, these are different types of meetings which may be convened. In other terms, which may be held by these public companies. So 8 marks for that. So part B of the question reads, state the rule in 𝐻𝐵 versus 𝐷𝐕𝑎𝑠 and explain the exceptions to the rule. The rule in 𝐻𝐵 versus 𝐷𝐕𝑎𝑠 and the exemptions So this is a rule which we discussed in this topic of meetings, And actually we say that this particular rule here, the rule in 𝐻𝐵 versus 𝐷𝐕𝑎𝑠 basically states that a meeting of a company cannot be duly constituted if attended by one person, even if that person is attending the meeting in more than one capacity. We say you can attend a meeting in more than one capacity. This whereby you are attending a meeting as a member of the company, and also you are attending as a proxy. You are representing another member. Provided it's only one person who is present, that meeting shall be deemed not to be properly constituted. So the rule state that a meeting of a company cannot be duly constituted by one member, even if he or she is attending the meeting in more than one capacity. In more than one capacity. In more than one what? Capacity. Even if that person is attending the meeting in more than one capacity. So attending the meeting in more than one capacity means that he's attending the meeting as a member and also as a representative, as a proxy of another what? Member. So that basically what this rule states. Then from there, we can give the exceptions to the rule. Exceptions to the rule. So first of all, what do you mean by the exceptions to the rule? What do you mean by the exceptions to the rule? The exceptions to the rule, basically, these are the circumstances whereby the meeting of a company can be duly constituted by one person by one person. So only one person who attended the meeting, but the meeting shall be deemed to be properly constituted, and actually any resolution which is passed in such a meeting shall be deemed to be valid. Shall be deemed to be what? To be valid. So which are those circumstances? Which are those instances whereby the meeting of a company can be duly constituted by one person? Number one is what we call the creditors meetings. The creditors meeting during the company's liquidation. During the company's liquidation. Now, if you can be able to recall what we said in relation to the topic of company's liquidation, we say whenever a company is being liquidated, meetings of creditors must be convened. One of the main objective of these meetings of creditors is for the creditors to be able to prove their debts, because we say that if, for example, by the time the company is liquidated, you are claiming the company, you're claiming some amount of money from the company as a creditor. There is an amount of money you have not been paid by that company. You have to prove which goods did you supply to that company. Do you have a supporting document? Which services did you provide to the company? Do you have a supporting document? You have to prove that. So therefore, we said there should be a number of creditors meetings. And now, in this case, we said if a company has got a single creditor, then that is the person who is entitled to do what? To attend those particular meetings and do what? And actually to attend those meetings. So therefore, during the company's liquidation, the meeting of creditors can be constituted. A creditors meeting can be constituted by one person where the company has got a single creditor. So number two, we talked about the board meeting. The board meeting of a private company. The board meeting of a private company. Board meeting of a private company. So in this case, we said private companies here are required to have a single director. And therefore, if a private company has got a single director, one director, that is the only person who is entitled to attend the board meeting. And that board meeting, even though attended by one person, the meeting shall be deemed to be properly constituted. Number three, we talked about what we call as the adjourned meeting. Adjourned meeting. So when we talk about adjourned meeting, this is a continuation of a meeting which was postponed due to lack of quorum. Remember, I said that if, for example, a company has convened maybe a general meeting of members, and the meeting do not have a quorum within 1 hour of the appointed time, within 1 hour from the time the meeting was supposed to start, then we say that the meeting will have to be called off. In other terms, the meeting will have to be postponed, or in other terms, it will have to be adjourned. It will have to be discontinued. We said the company should convene, or another meeting will be held next week, the same place, the same time, unless resolved otherwise by who? By the directors. And actually, all the members will be notified that the meeting didn't take place because there was no quorum, and therefore they are expected to attend the following week. So if coming next week, still one member attend, that meeting shall be deemed to be duly constituted, and actually the meeting shall proceed and transact those businesses which were supposed to be transacted by the members. So adjourned meeting. So then we have number four. We have what is called a meeting convened by the registrar of companies. So the registrar of companies can issue an order requiring a company to hold a certain meeting, and equally in this case, the registrar will still order that even if a single person attend, the meeting basically go ahead and basically transact those particular businesses which the registrar of the companies which the registrar has actually ordered to be transacted in such a meeting. So number 5, we have a meeting convened by a court order. So these are those particular meetings which are convened as a result of an order issued by the court. So in this case, the registrar court will actually may order as a meeting to be convened and still order that even if that meeting is convened is attended by one person, the meeting should go ahead and transact those businesses which the court has ordered to be what? To be transacted. To be what? To be transacted. To be what? To be transacted. To be what? Transacted. Yes, automatically this one should be the High Court. This one should be the High Court. This one should be what? This one should be the High Court. Yes, I think we can talk over those 5 exemptions, but also remember we have others. We have other what? Other exemptions. We also have other exemptions. So I think maybe we can just talk over the 5. We can talk of the 5, but remember we also have others. Yes. So let's go to the last part of the question, whereby we are required to define what is a special notice. What is a special notice? What is a special notice? Special notice. Special notice. Now, we say that special notice, basically, this is a notice which must be given to the company by its members 28 days before. So the number of days is very important. 28 days before a certain meeting. For example, in this case, we say if the members of the company intend to remove the director or one of the director in the forthcoming AGM and maybe replace him with another director, they want to remove the auditor and replace him, the returning auditor, replace him with another auditor. So they must give the company a special notice. So therefore, this is a notice given to the company by members 28 days before the day of the meeting, 28 days before the meeting, before the meeting, informing the company about their intention to pass a certain resolution. To pass a certain what? Resolution. So this is a notice which is given by the members 28 days before, that is given to the company by the members 28 days before the meeting or before the date of the meeting, informing the company about the intention to pass certain what? A resolution. Equally, we can say that this notice is required for what? Or when should this notice be given to the company? When should this notice be given to the company? Number 1 is when the members of the company intend to pass a resolution to do what? To reappoint a director who has attained the retirement what? Age. So this notice is required for a resolution to do what? To reappoint a director. A director who has attained the retirement age. The retirement what? Age. And who can be able to recall? We said a director should retire after attaining the age of how many years? A director should retire after attaining the age of how many years? A director should retire after attaining the age of 70 years. The age of 70 years. The age of 70 years. So we said, assuming a director has attained the age of 70 years, maybe in April here, and maybe our company will be holding its AGM in June. So basically, we said this particular director here, who has already attained the retirement age, is not supposed to retire in April, but rather this director is supposed to notify the company that he has already attained the age of the retirement age of 70 years, and that director is supposed to retire in the forthcoming AGM. In the forthcoming what? AGM. So automatically, in the notice which will be sent to the members about this AGM, the members will be notified that one of the director has attained the retirement age, and therefore he will be retiring in the forthcoming AGM. But in this case, the members of such a company may be happy with the services or with how that director has served the company, and they wish to reappoint him back despite having attained the age of 70 years. So we said for the members to do that, they must give the company a special notice. They must notify the company 28 days before that AGM that they want to reappoint that director back in the office despite having attained the age of 70 years. That's why we are saying that this notice is required, number one, for a resolution to reappoint a director who has already attained the age of 70 years. Number two, this notice is also required for a resolution to remove the auditor from office, to remove the auditor. Number three is also required for a resolution to remove the director. To remove who? The director. To remove the director. So therefore, this particular notice here is required for those resolutions. Is required for those what? Is required for those resolutions. Yes. So that is it. That basically what is required as far as those questions are concerned. Those questions are concerned. So what I want us to do is maybe just take a short break of 10 minutes, and then we come back. I want us to look on this other paper. That other paper. I've reshared the paper in the class WhatsApp group. So we come back and basically look on some of the questions from that paper. Yes, so we take a short break. Short break of 10 minutes. We come back at 1:15.
check whether
confirm, please confirm that question with you. August of 2024, and that is the question 4B. Question 4B. Are you there? Zido, are you there? Steven, are you there? Sam, are you there? Martin, are you there? Mother, are you there? Doris, Anna, are you there? Lydian, do you have the question with you? Perfect, perfect. Okay, so what are we told as far as this particular question here is concerned? So this is a very good question on conversion of partnership business into a limited liability company. And the question is, that is specifically part B. So we are told John, Kelvin, and Renette have been into partnership for several years, sharing profit and losses in the ratio of 5:3:2 respectively, after allowing for a 10% interest on fixed capital balances of the partners. No salaries or commissions were to be paid to the partners. The trial balance is at 30th of June 2024, extracted from the financial records of the business, revealed the following. So we're given the trial balance there. One, we have the profit for the year. We have the inventory as at 30th of June, of 2024. Account receivables, account payable, bank overdraft, property at carrying amount. Remember, I've said carrying amount is the same with the net book value. That is what you need to remember. We have the motor vehicle at carrying amount, office equipment at carrying amount, equity investment at fair value. We have the partners capital account, partners current account drawings, and then we have the loan from Kelvin. We have additional information. Number one, you're told actually in the first paragraph there, we are told the partnership was converted into a limited liability company, JKL Limited, with effect from 1st July 2024 under the following terms. Number one, you're told the purchase consideration of the business purchase was agreed at 150 million, and the new company issued 15 million ordinary shares of shares 10 per value in full satisfaction of the purchase consideration. So the new company was to pay a purchase consideration of 150 million. This was to be paid by the new company issuing its own shares, issuing 15 million ordinary shares, each share having a par value of 10. Number two, we are told equity investment were taken over by the partners at the fair value of 18 million and allocated to the partners in their profit and loss sharing ratio. Equity investment is basically investment in shares. This one was not taken over by the new company, but rather this one was taken over by partners. So therefore, this is an asset which was taken over by partners. And then from there, we are told number three, the loan from partner Kelvin was transferred to the new company at the carrying amount. Number four, other assets and liabilities of the partnership were taken over by the new company at the following values. At the following what values? So we are given the assets which were taken over, the assets and liabilities which were taken over by the new company. We have property, we have plant and machinery, motor vehicle, office equipment, and we are given the value at which we were taken over it. Then we have inventory which was taken over at the book value less 15%. Account receivable was taken over at book value less 10%. Current liabilities were taken over at the book value. Finally, number 5, we are told the new company issued 2 million ordinary shares of shillings 10 at each at par value. The proceeds from the issue were utilized to settle the bank overdraft and the loan which was taken over with the balance used as working capital. So what are we required to do here? We are required to prepare the foreign ledger account to close off the books of account of the partnership. Number 1, the realization account. Number 2, the partner's capital account. And number 3, the partner's capital account. So actually, those are the accounts which are prepared to close off the books of account of the partnership. Then Roman 4, we are required to prepare the opening statement of financial position of the new company called JKL Limited on 1st of July 2024. So what we are going to do first of all is to cross off the books of account of the partnership by preparing the first 3 accounts: realization, partner's capital account, and then the partner's capital account. But before we do that, if you go back to the trial balance which you're given, can we go back to the trial balance? The first item in that trial balance which you're given is the profit for the year. Now, let me ask here, what happens to the profit of the partnership? If, for example, we are partners in a partnership business and our business has reported a profit, what happens to that profit which is reported by a partnership business? Who can tell us? What happens to the profit which is reported by partnership business? Where does that profit go? Where does that profit go? Is it retained as a reserve? Is it supposed to be shared? Yes, automatically, once a partnership business reports a profit, that profit is supposed to be shared among partners. We know from the definition of a partnership business is an association of partners who carries on a business with an objective of making and sharing profit. So any profit which is reported by the partnership business is supposed to be shared among who? Partners. How do we share that profit? We share that profit from what you did in the topic of partnership in financial accounting. We share out that profit by preparing something called the appropriation account. And therefore, even before we cross off the books of account of the partnership, so the first thing we need to do is to share out that profit among the partners. We are going to share out that profit by preparing something called the partners, the appropriation words, the appropriation account. So let's first of all, we prepare that account, which is called the appropriation account. So why are we preparing this account? Is to share out that profit. Appropriation what? Appropriation account. Appropriation account. And I hope you can be able to recall the format for this account, the format for appropriation account. Okay, so the figures which are given here, they are in million of shillings. So basically here, we should have 2 columns. 2 columns like that. So in preparing this particular account here, we always start with the profit for the year. Profit for the year. I hope you can be able to see that far ahead. We always start with the profit for the year. And then to this profit, we usually add the interest on drawings. We usually add the interest on drawings. The interest on what? The interest on drawings. After adding the interest on drawings which is charged to the partners, we then proceed and we raise the appropriations. When we talk about the appropriations, this is what the partners are entitled to from the partnership business, e.g. the salary and commissions, e.g. the things like what? The interest on capital and the share of profit. The share of what? The share of profit. So let's prepare this. So we're going to start by recording the profit for the year, which we are given in the trial balance, the first item. The first item in the trial balance is the net profit for the year, which is basically 42,800. Then we need to check what the partners charged any interest. When we talk about the interest on drawings, this whereby drawings is basically money or goods you take from the partnership business. The partners may have agreed that if you have taken some cash, you have taken some goods from the partnership business for your personal use, you'll be charged an interest because it is like you are borrowing from the partnership. So once you are charged an interest, that one should be added to the amount to be shared. Sasa, yes. So we must be given that in the first paragraph of the question. We are told John, Kelvin, Renette have been in partnership business for several years, sharing profit and losses in the ratio of 5:3:2, after allowing interest on fixed capital at the rate of 10%, no salaries or commissions which were paid to the partners. And then if you go to the additional information number 1 all the way to note number 5, there is nowhere we are told the partners were charged interest on drawings. Because if you go to the trial balance, down there, above the loan from Kelvin, we have drawings. So, but there is nowhere we are told the partners were charged interest on what? Drawings. But if there was any, we should add it here so that we get the amount to be shared among partners. So this is what the partners will share. So how do the partners share out this? So this one will, or basically what we do, we list now the appropriations. Appropriations basically refers to any amount of money which the partners are entitled to from the partnership business, like maybe the salaries, all what, all commissions. And there is something which you're told in paragraph 1 that the partners were not entitled to salary, they were not entitled to commission. So what they were entitled to, as per the first paragraph, is the interest on capital. Interest on what? On capital. So what we need to do here is to compute the interest on capital which each partner was entitled to. As per the first paragraph, we are told the partners were entitled to interest on capital at the rate of 10%, and this one should be computed based on the fixed capital balance. This one should be computed based on the capital contributed by each partner. So if you go back to the trial balance, we're given the capital account balance of each partner. The capital account balance of John, Kelvin, and Renette. So what we need to do is to compute the interest on capital which the three partners were entitled to. That is John, Kelvin, and who? And Renette. So, and we are told that this one would be 10%. This one would be 10% of their capital account balance. So their capital account balances, this is something we are given in the trial balance. I hope you can see those capital account balances. So the capital account balance for the first partner, who is John, is 43,700, which 10% will give us 43,70. Then Kelvin is 28,500. 10% of that will be 28,50. Then Renette is 18,800. 18,800. 10% of that will be 18 what? 18,80. 18 what? 18,80. So remember, this is what the partners will be entitled to, will be paid, and this one has to be paid. This one has to be paid from this. This one has to be paid from what we have up there. 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 You're saying my video is not clear. I can see from my side is clear. I can see from my side is clear. Is the video not clear? Maybe someone to confirm. Is the video not clear? I can see from my side it's clear. Yes, from my side is very much clear. From my side is very, very much clear. Very, very much clear. Very, very much clear. Very, very much clear. Sasa. Anna, is the video now clear? Ama bado? Maybe the internet on your side, Anna. Maybe the internet on your side. I'm already in class and I can see my video is very much clear. Very, very much clear. So maybe you can exit, then rejoin very fast. Exit, then rejoin very fast so that we continue. Yes. So basically, that is it. Yes. So in our case, we have already computed the interest on capital. This is what the partners, one of the appropriation or one of the items the partners will be entitled to from the partnership business, So then from there, the other appropriations the partners may be entitled to, will be entitled to is what? Is the share of profit or the share of loss. So how do we determine the amount to be shared as profit or the amount to be shared as loss? So basically what we do is that we take this amount to be shared minus what we have there. Remember, you don't have salary or commission. We will rest those interest on capital. If we get a positive figure, that is a profit to be shared. If we get a negative figure, is a loss, is a profit to be shared. If it's a profit, if it is a positive, is a profit to be shared. If it is a negative, is a loss to be shared. Automatically, this one will be a positive. Because if you take 42 minus this, we're going to have a positive figure. So being a positive figure, that is a loss to be, that is a profit to be shared. So here we will have share of what? Share of profit. So can we determine the amount to be shared as profit? So we take that minus this interest on capital. So you have 42,800 minus 43,70 minus 28,50 minus 18,80. So the amount to be shared as profit, I'm getting 33,700. Now that a profit would be shared among our three partners, John, Kelvin, and who? And Lynette. So they will share a profit of 33,700, 33,700. And how will this profit be shared? This profit will be shared using the profit and loss sharing ratio, which we have in the first paragraph. The profit and loss sharing ratio in the first paragraph of our question is 5:3 is to 2. 5:3 is to 2. That is for John, Kelvin, and what? And Lynette. That's basically how they will be sharing the profit or the losses, the profit or the losses. Yes, the profit or the losses. Someone is asking a question here. Drawings about drawings here. No, I've said this. What are drawings? Number one, I've said drawings is when you go to the business, to the partnership business, you take some cash, you take some goods for your personal use. So whatever we add here is not drawings. We add the interest because we are saying if you go to the partnership business and you take money, you take goods for your personal use, in most of the cases, the partners will have agreed that you'll be charged an interest. Once you are charged an interest to the partnership business, it is like an income. It will increase the amount to be shared among who? Partners. Whatever we add there is not the drawings. We add the interest. We add what? The interest. Like is like an income. That's why we are adding it here to increase the amount to be shared among who? Partners. Awesome? Yes. So let's determine the amount to be shared by each of the partners. So the first thing we need to do here is to get the total. So this is the 810. So the amount which John will share will be 5 all over the total, 5 all over 10, Kelvin 3 all over 10, and Lynette 2 all over 10. 2 all over 10. So that is basically how we compute the amount to be shared. That's how we compute the amount to be what? The amount to be shared. The amount to be what? To be shared. So we have that 700 times 5 divided by 10. So which will give us 16,850. Kelvin, we take 33,700 times 3 divided by 10. And basically that will give us 10,110. And then the other partner, the net, that is 3,700 times 2 divided by 10. And basically that will give us what? 6740. 6740, yes. So then we know that this amount now has been shared among partners. So therefore, if you take this amount and then you less all this, you should get 0, because that amount of profit has been shared among who? Has been shared among partners. Now, once we are through with that, then we can proceed and basically cross off the book of account of who? Of the partnership. I want us to move and cross off the books of account of the partnership by preparing the 3 accounts which we are required to prepare in our question. So the first account we are required to prepare is the account which is called the realization account. The realization account. Realization account. So what we just need to remember here is, what do we record in this particular account, the realization account? What do we record in this account? And our figures will be 1,000 of shillings. Will be 1,000 of shillings. This is basically the debit side. So the realization account, we have a number of items to be recorded here. Then from there, in Roman 2, we are required to prepare the partners what? The partners current account and the partners capital account. Partners current account. Partners current account. Remember, this account is also, this one is a ledger account. Is a ledger account. Partners current account is basically a ledger account. Ledger account means that this account will be having a debit and the credit side. The debit and the credit side. But here, taking into account, we have 3 partners. On the debit side of this account, we have the details column, and columns equal to the number of partners. How many partners do we have? We have 3 partners. So we will have the details column here, and then column for the 3 partners. We have the first partner, who is John. We have Kelvin, and we have Renette. And also our figures here will be 1,000 of shillings. Will be 1,000 of shillings. So we do the same on the credit side. Details column, John, Kelvin, and Renette. And also our figures here will be in 1,000 of what? Of shillings. And then Roman 3, we're required to prepare the partners capital account. So the reason why I'm having all these accounts, because I want us to prepare all these accounts concurrently. As we go through that balance, whatever is affecting this account, it will be posted to the respective account. Yes, so the partners capital account do have the same format with the partners current account. This account has the same format with the partners current account. So we have the details column, and basically columns equal to the number of partners. So we have John, we have Kelvin, and then we have Renette. We have Renette like that. So then on the credit side, we have the details column. We have John, we have Kelvin, we have Renette. This, remember, is the credit side. And also the figures are in what? In 1,000 of shillings, like that. In 1,000 of shillings. So I think now we can move and basically prepare these accounts. Let's move and basically prepare those accounts. Let's move and prepare those accounts. Let's move. Now, how do we prepare these accounts? Now, what we need to recall is, for example, what do we record in this account? Remember from our discussion, I've said when preparing this account, we record like 3 key items. In preparing the realization account, I've said on this side, we record the assets, which are taken over at the carrying amount of the net book value. On this side, we have the liabilities, which are taken over, and the purchase what? Consideration. That is the first thing you need to remember, what we record in this account. Asset taken over, the liabilities taken over, and the purchase what? Consideration. Then, if it is now the partner's current account, you need to recall whatever you are recording here in financial accounting. In financial accounting, when you're preparing this account, you are recording the partners, the opening balance in this account, in this account, and then on this side, you are recording, I think, 3 items: the drawings, interest on drawings, and share of loss. On this side, you are recording the share of profit, the salary to partners, the commission to partners, and the share of profit. And then this account generally we record the opening balance, the partners, or the opening balance in capital account, and any loss or gain on realization, which you have said must be shared among partners using the profit and loss sharing ratio. But basically what we need to do when closing of the books of account of partnership, what you do for you to get it right, go back to the trial balance which you're given here, and you need to close all those accounts. You close off all those particular accounts without skipping any. So the first item is the net profit. Now, this net profit, we know that this one has been shared among partners. And therefore, these particular items here, that is any interest on drawings, any salary or commission, any interest on capital, and the share of profit, all these, they'll be posted to this account. But even before you post these items here, we definitely need to record the opening balance here. So we are going only to post this one here after recording the opening balances. But all these items will be posted in this account. So then below that, what do we have? We have inventory. And actually what you're given here are items of assets and liabilities of the partnership. Now, what we need to do is basically to make reference to note number 2, to note number 3, to note number 4. The additional information with number 2, 3, and 4. Can we quickly go to note number 2? Note number 2, we are told equity investment, which you have said is investment in shares by the partners. This one was taken over by partners. This is an asset which was taken over by partners. Remember, you have said any asset taken over by partners should be debited in this account, should be debited in the partner's capital account, and then credited in the specific asset account. So one of the assets taken over by partners is the equity investment. Number 2, we are told the loan from partner Kelvin. That is the last item in the trial balance, was transferred to the new company. Is the liability of the partnership, it was transferred to the new company. Number 4, we are told other assets and liabilities of the partnership were taken over by the company. So we are given the assets and liabilities which were taken over by the company. Property, plant and machinery, motor vehicle, office equipment, inventory, account receivable, account and the current liabilities, all those were taken over by the partnership. So having that information now, we can go back to the trial balance, the second item. So the second item we have there is inventory. Inventory, as per note number 4, is one of the assets which was taken over by the new company. So that being an asset which was taken over by the new company, we debit it in the realization account at the carrying amount. The carrying amount is the value we have in the trial balance. So we will have inventory here. This is basically one of the assets which was taken over, and its carrying amount is the value we have in the trial balance. Note the value which is given in note number 4. So the carrying amount for this is basically 28,400. 28,400. Below that, we have account receivables. As per note number 4, still account receivables was still taken over by the new company. So this is the other asset which was taken over by the new company. What is the carrying amount? The carrying amount is still the amount we have in the trial balance, which is 23,800. And I hope you can see I'm not even considering the values we have in note number 4, because we are going to use those values when opening the books of account of the new company. But when crossing off the books of account of the partnership, I've said we account for those particular assets at their carrying amount or the net book value. Sasa, yes. So below account receivables, we have account payable. Account payable is a liability. Now, what still we are told in note number 4, we are told all current liabilities were still taken over by the new company. So the liabilities which are taken over by the new company in our realization account, they should be credited. So that being a liability taken over by the new company, we credit it here. So their value for that is, the carrying amount for that is 32,700. Below that, we have bank overdraft. Still, that is a current liability. As per note number 4, it was still taken over by the new company. So we credit it here. The bank what? The bank overdraft. The bank overdraft, which is how much? Which is 68. So then we go to the other item, which is down here, and that is the property at carrying amount. Property, as per note number 4, still it was taken over by the new company. So that is an asset which was taken over by the new company. What is the carrying amount in the trial balance? 72,950. I hope you can see still I'm not using the values we have in note 4. Those are the fair values. We are going to use them when opening the books of account of the new company. Below property, we have plant and machinery. Still, as per note number 4, plant and machinery was taken over by the new company. So we debit that here at the carrying amount, which is in the trial balance. That is 730. So below that, we have motor vehicle. Still, as per note number 4, motor vehicle was still taken over by the new company. The carrying amount of motor vehicle is 10,580. So below motor vehicle, we have equipment. Still, as per note number 4, equipment were taken over by the new company. The carrying amount for this is 25,240. So, and then from there, we have equity investment. Equity investment, this one, was taken over by the partners. So being an asset taken over by partners, are we supposed to debit that here? No. We have said those assets which are taken over by partners, they'll be debited in this account, the partners capital account. So here we have equity investment, but basically we need to go back to the information which we have in note number 2. Can we go to the information we have in note number 2? We are told the equity investment, note number 2, equity investment were taken over by partners at their fair value of 18 million and allocated among partners using their profit and loss sharing ratio. Now, if you go back to the trial balance, you can see we are given the equity investment, and basically we are given the equity investment in the trial balance at the fair value. The fair value given in the trial balance is 10,000, but you're told in note number 2, this equity investment were taken over by the partners at their current fair value of 18 million, and this one was shared among partners, was distributed among partners using their profit and loss sharing ratio. So basically what that means is that this particular investment were taken, when it was being taken over by the partners, it had a value of this. So therefore we are going to share, or the partners will share this asset at this value, not at 10, but at 18. And therefore, how do we account for this? Which double entry are we going to make in relation to this equity investment? Remember, this equity investment, this one is recorded in this account at this particular amount. So, and basically remember, this is an asset. This is what? An asset. So therefore, this is a debit balance on this account. So what we need to do is we cross off that account because those investments were taken over by partners. So we need, first of all, to cross off this account. So automatically we will cross off that account with 10,000. So therefore here you can see we are crediting this account, which is called equity investment, with 10,000, then we will debit this account. We will debit the partner's capital account, but this account will be debited at 18 million. At 18 what? Million. So how do we account for the difference? The difference, which is 8,000. You can see this account has been debited with 18. So this account credited with 10. So we have now to credit another account with the difference. And actually this difference, we can refer to it as a revaluation gain, because When these equity investments were taken over, they were revalued from 10 million to 18. So these are revaluation gain. Now, this revaluation gain, where do we take it? So this revaluation gain will be taken to the realization account. Will be taken to the realization what account? Because by the end of the day, we have to complete a double entry. We debit this account with 18 million. We credit equity investment with 10, and still we credit the realization account with 8. So therefore, that 8 will be credited here. It is a revaluation gain on equity what? Equity investment, which is 8. Then we need to debit this account with the 18 million. But remember, those investments were taken over by the 3 partners. That's why we are told in note 2, they will be distributed to partners using their profit and all sharing ratio. The profit and all sharing ratio we know is this: 5 all over 10, 3 all over 10, and 2 all over 10. So we are going to take the value of the investment. The investment was taken over at a value of 18 million or 18,000 for that case. So we share out that using this. So the first partner will get 5 all over 10, which is basically half, and that is 9,000. The other partner will get a share of 3 all over 10, which is basically 54. And the other partner will get a share of 2 all over 10, which is basically what? Which is 36. Which is what? 36. If you add all that, it should give us an amount of 18. That's basically how we account for that equity investment, which was taken over by partners. Let's go back to the trial balance. And I hope you can see there is nothing we have skipped there. We have accounted for all those items. What we skipped is the first item. That is the profit. Then below equity investment, what do we have? We have the partner's capital account. Now, the partner's capital account, that would be the opening balance in this account. And I hope you can see those balances in the partner's capital account in the trial balance. They are on the credit side. So what do? We record those balances here and we record them as credit balances. So the capital account balance for Kevin has a balance for John, that is 43,700, Kevin 28,500, and Renette 18 what? 18,800, 18,800, 18,800, 18,800, 18,800, 18,800. Sasa 18,800. Yes. So then from there, below that we have current account balances. Current account balances, those are balances to be recorded in this account. So, and equally, I hope you can see the current account balances, they are credit balances. In the trial balance, they appear on the credit side. For Zone is 14,790. For Kevin is 12,960. 960, and basically for the net is what? 98.50. 98 what? 98.50. 98 what? 50. 98.50. So then below that we have drawings. We have drawings. Where do we record drawings? Drawings, those ones are supposed to be credited, to be debited in this account. Remember, I've said from whatever you did in financial accounting, you should be able to recall what we record in this account. On this side, we record drawings. In case we had any interest on drawings, that one should also be debited here, but I hope you can remember you don't have any interest on drawings. In case we have share of loss, that one equally should be debited here. And then in this account on the credit side, we record what? We record any salary or commission to partners. Do we have any salary or commission to partners? None. Then we should also credit this account with interest on capital. And I think we have that. And then also what? The share of a profit. The share of what? The share of profit, like that. Sasa? Yes, Doris, what you have said is that the investments which were shared by partners, they are shared at a value of 18 million. At a value of 18 million. That's what you're told in note number 4. We have shared out this investment at a value of 18 million. That's what you have said. That's why you have said we debit the partner's capital account at 18 million. So if you add all that, should give us 18 million. Yes. Now, what I want us to do before we move, we go back to the trial balance, I want us to record these items because we have recorded drawings. We have recorded drawings. Before you finalize, okay, I think let's first of all finalize with what we have in the trial balance. Below the drawings, what do we have below that? The loan from Kelvin. And there is some information which are given in relation to that. Note number what? Note number 3. Additional information number 3, we are told the loan from Kelvin was transferred to the new company at its carrying amount. So loan from Kelvin is a liability. So that loan was transferred to the new company. So that is basically a liability. That is a liability which was taken over by the new company. So the loan from Kelvin. So, and I hope you can remember liabilities taken over by the new company. They should be credited in this account. So how much is the loan from Kelvin? The last item in the trial balance. The last item in the trial balance is 91. So that is a liability which was taken over by the new what? By the new company. So I think you can see we are done with crossing all those balances, all those particular accounts which are balances at the end of the year. Now what is remaining is for us now to post these items here. So these appropriation. We have said in case we had interest on drawings, that one should be debited here. Salaries and commission to partners should be credited here. Then we have interest on capital should be credited here. So let's credit interest on capital here. So for John is 43.70. For Kelvin is 28.50. And basically for Inet is 18.80. Then we also have the share of profit, this one. So John is 16.850. Kelvin is 10.110. And Renette is 67 what? 40. 67 what? 40. So we are basically done with posting those items there. Now what is remaining is basically for us to balance this account. Okay, before we do that, there is something we are almost forgetting. Can we record the purchase consideration which is given in the last note? The last note, note number 5. Sorry, not note number 5, note number 1. In note number 1, we are told the purchase consideration on a business purchase was agreed at 150 million. Where do we record the purchase consideration which was agreed? The purchase consideration record in the business purchase account should be credited. The purchase consideration which was agreed. And that is 150 what? Million. 150 million. I think basically we are done. So what's the remaining for us to balance this particular what? Account. Now the first account which we have to balance is this one, the partner's current account. Partner's current account. Now this basically account shows the amount of money which the partners were entitled to receive from the partnership business. So the balancing figure from this account should be crossed off, should be transferred to this account. So that by the end of the day, we know the amount of money which each partner was entitled to receive. So the first account which we balance is this account here. Is this account here. So let's start by balancing this account here. And I've said the balancing figure will be crossed off to which account? Will be crossed off to the partner's capital account. So how do we balance this account? We balance the current account for individual partners. So we will start with John. So we compare what we have on the debit and basically what we have on the credit. So I think on the debit side, we don't have any amount. What about on the credit side? In the current account of John, we have 14,790 plus 43,70 plus 16,850. That's what we have on the credit side. So we take what we have on the credit side minus what we have on the debit side. On the debit side, we have 0. So we should take 36,010 minus 0. So the balancing figure will be on this side. Do we record it here as a balance carried down? No. So that balance I've said we transfer it to this account. So that balancing figure, that is 6,010. Oh, yes. Thank you, Otito. Morimo is almost forgetting to record drawings. Thank you. Yes, we have drawings. We didn't record the drawings. Sorry for that. So the drawings we have 43, 70, 40, 20, and what? and 29 what? 10. Thank you for that. Yes, so it basically means that we need, before we get this, we need to raise the drawings here. We need to raise 4370. 4370. And the amount which we get here will be 31, 6 what? 40. Now we cross off this particular amount. We cross off this particular amount to which account? To this account. And basically we follow the rule of double entry. You can see this account is credited. Sorry, is debited, sorry. Then to complete the double entry, we need to credit this account. We credit this account. So we will say that there is an amount coming from the partner's current what? Current account. The amount from the current account of John is this one, 31 what? 640. So we do the same for the other partners. So Kelvin, we add what you have on the credit. Whatever you have on the credit side is what is more. 12,960 plus 2850 plus 10,110. That is what we have on the credit minus these ones. Minus this value here, 4020. And that will give us 21,900. We debited here, we credited here to complete the double entry. So we do the same for Inet. So for Inet, we have 9850 plus 1880 plus 6740 minus what you have on the debit, 2910. And basically, I'm getting 15,5 what? 560. 15,5 what? 60. Are you getting those values? Is that what you're getting? Yes. So basically, in our case, we are done with this account. This is now what was required here. That is what was required in the partner's what? In the partner's current account. Now, then next, what we need to do is basically we balance this account. Now, what you have said is that this account will be having a balancing figure, and the balancing figure in this account can either be on this side. If it is on that side, it is a gain on realization, and that has to be shared among partners using their profit and loss sharing ratio. If the balancing figure is on this side, is a loss on realization. Equally, it will be shared among partners and taken to the partner's capital account. If the balancing figure is on this side, it is a gain on realization. Yes, can we balance this account to see whether we have a gain or what? We have a gain or basically what? A loss. So let's add what you have on the credit, that is 2,700 plus 68 plus 8,000 plus 9,100 plus 150,000. So basically, I'm getting 206,600. That is what I'm getting on the credit. What about on the debit? And you confirm whether you're getting the sum, that value on the credit. On the debit, we have 28,400 plus 23,800 plus 72,950 plus 37,730 plus 10,580 plus 25,240. So on the debit side, I'm getting 198,700 on the debit, and that is what I have on the credit. Are you getting those values? Then we can. Are you getting those values? Yes, so that is confirmed. So meaning that the side which is more is on that is this side, the credit side, profit or loss, the statement of profit or loss, which is basically for the year, which is for the year, which ended 31st of October 2024, for the year which ended 31st of October 2024. So we need to have just a single column here. And always we start with the revenue. We start with the revenue. Remember, we said as you come up with the skeleton, this skeleton, record the values you're given in the trial balance here. So, yes. So the revenue is basically the first item in the trial balance, which is the 278 400. We say that value, if for example you leave it at that point, it will still be marked. It will still be what? Be marked. Just leave it there. Then to this, we need to less the cost of sales. Is the cost of sales given? Is the cost of sales given in our question here? No, because I can see in this trial balance, I can see purchases. In the trial balance, I can see opening inventory and so on. So how do we compute this? We take the opening inventory, that is the third item from the bottom of the trial balance. Opening inventory, that is 37,800. That is 7,800. So to this, we add purchases. Purchases is still down there below accumulated depreciation in the trial balance, and that is an amount of 78,200. And then to this, we less crossing inventory. I hope you can remember crossing inventory is in the additional information number 1. Note number 1. Additional information number 1, 43.2 million. In thousands of shillings, it will be 43,200. That is basically the inventory at the end. So then the number of adjustments which we make to this, for example, any depreciation should be added here. So remember, you have this depreciation on right of use asset. We have said that this one should be included within the cost of sales, 18,347. 18,347. Yes. So then from there, we will basically compute the other depreciations. We include them here, and then we get the gross profit. So after getting this gross profit, we said we proceed and we add the other incomes. We add the other incomes. Remember, when checking for the other incomes within the trial balance, we check the items appearing on the credit side of the trial balance. Credit side of the trial balance. What do we have on the credit side? Up here, I can see we have revenue. Below that, we have something called income from investment. Income from investments, that is basically part of the other incomes. Income from who? From investment. So the income from investment, let's just record that here. In case there is an adjustment, we'll do it here. We record the final values here. Below that, we have ordinary share capital, retained earnings, 10% loan stock, account payable, deferred tax, bank balance. All those are basically not incomes. And then still down, I'm checking the items only on the credit side because all incomes have a credit balance. I can see accumulated depreciations. Are those incomes? No. So then I think maybe you can just leave a line here or two such that we proceed and we record now we record the expenses. So for the expenses, we go back to the trial balance, we check the items appearing on the debit side, but automatically we say in this question, expenses will be 3 here: distribution, admin, and finance cost. So where do we have the expenses? We check the items on the debit column of the trial balance. I can see we have land and buildings, plant. Then down there, I can see we have purchases. Below purchases, we have distribution. And I've said you can leave 2 lines here before recording the expenses. Distribution. So this one is an amount of 10,000. So below that, we have the administrative expenses. So the administrative expenses is 55. Is 55. That's basically what we have. 55. Then loan interest paid. Loan interest paid, that one is part of the finance cost. You record it here. You record it here as part of the finance cost. So which is basically an amount of 2,000. 2,000. But equally in this case, we have to recall that we have interest on leases. So this interest on leases for the current year, this one we have said is taken to the statement of profit or loss as part of the finance cost. So we add an amount of 69.74. The interest on leases. The interest on leases. So below that, we have dividends which were paid. That will go to the statement of changes in equity, opening inventory account, receivable. Then we have investment. So basically, we don't have any other expense. We will have the profit before a tax, and then to this we less what? We less income tax expense. Remember, we say that this income tax expense, this usually comprises of 2 components of taxes. This one comprises of 2 components of taxes, the current tax and also the deferred tax. So we will record the current tax, and this is given somewhere within the additional information. and basically the deferred tax. Remember, this deferred tax can either be a deferred tax income or a deferred tax expense. We will see what you're told in the additional information. Is it a deferred tax income? Is it a deferred tax expense? And then from there, we get the profit after tax. We get the profit after tax. After that profit after tax, what do we add? We proceed and we add other comprehensive incomes. We proceed and we add other comprehensive incomes. Remember, you say that these other comprehensive incomes, these include things like the revaluation gain or loss on PPE. So I think there is some information which is given in relation to that in note number 2. And then from there, we will get what? The total comprehensive what? Incomes. Yes, so that is basically a skeleton of what we are required. So then we have a skeleton of part B. Part B, a statement of changes in equity. Statement of changes in equity. Statement of changes in equity. Now, for the statement of changes in equity, here we need to have, first of all, the details column. Details column. And then we go back to the trial balance, we see which items of equity was our company having. So remember the items of equity, we consider share capital and reserves. So therefore, in the trial balance, we check the items appearing on the credit side. Items appearing on what? The credit side of the trial balance. After you can see we have revenue, income from investment. Are those items of equity? No. So then below that, I can see we have the first one, which is basically ordinary share capital. Remember our figures here equally and in thousands of shillings. So below that, I can see we have retained earnings. Retained earnings. Retained earnings. So retained earnings. So then below that, we have 8% loan stock, account payable, deferred tax, bank balance. Actually, I think we don't have any other. What about in the additional information? Yes, I think in the additional information about there were some assets which were revalued, landed buildings. So automatically that means that we will have a column for revaluation reserve. Make sure you write that in full. Revaluation reserve. For your revision purpose, we will have revaluation reserve. You write that in full for your revision purpose. Revaluation reserve there. Yes. So then note number 3, 4, 5. I think we don't have any other items. So then we will have what? The total. The total. So what we start by recording here, and basically opening balances, and we say even by recording those opening balances, those are 3 months. Ordinary share capital, this one is 150,000. Retained earnings is 119,500, and then that one was 0. So no need of getting those totals because we say they are not marked by the end of the day. Then in the trial balance, even before we move now to what is required in part C, in the trial balance, I think I can see dividends. Can you be able to see the dividends which were paid during the current year? How much dividends were paid during the current year? Because that is something we need to capture here. The dividends which were paid, how much? How much dividends were paid during the current year? The dividends paid during the current year were 15,000. 15 what? 1,000. Remember, in this case, we say dividends are paid from the profit. So dividends paid, that one deducted here. That is a free mark. 15,000, like that. You can equally take it to the last column, though whatever you have in the total column is not marked. Yes. So basically, by recording those values, those are just marks, free marks. So then we leave some space there. We have part C, statement of financial position. Statement of financial position as at 31st of October 2024. 31st of October 2024. 31st of October 2024. So equally here, we just need to have a single column, and we start by recording the non-current assets. The non-current assets, the non-current assets. So for the non-current assets, remember, we start by recording the PP. PP, we say that this comprises of all tangible non-current assets. And I think we have a number of tangible non-current assets. In the trial balance, we have land and buildings, and I think we have plant and equipment. So I think we will deal with that once we go through the additional information, because we must compute the depreciation for the current year. Yes. So PP, then the last item is the trial balance. The last item is the trial balance. I hope you can see we are given investment, and basically you told that that investment is a long term. So if an investment is basically a long term, that is a non-current asset. That is a non-current what? Asset. And basically the value for that is what? 90. Will that have any adjustment? No. So a long-term investment is a non-current asset. The other item which you also need to recognize here is what you have computed here. This right of use asset. The right of use asset, we also recognize it here as one of the non-current assets. Right of use asset. And basically we recognize it here at the net book value. The net book value is this one minus the depreciation, which is basically 73, 390, 300 and what? And 90. Yes. Do we have any other non-current assets in the trial balance of the debit column? I can't see any other. So we move, and basically we record the current assets. We move and record the current assets. We move and record the current assets. We move and record the current assets. So the current assets, I think we have a number of them. Equally, we check the items appearing on the debit column of the trial balance. I can see landed buildings, plant and equipment. Those are not current assets. Down here, I can see we have purchases, distribution, admin, loan interest paid, risk plant rentals, plant rentals. This is the amount which was paid during the current at the start of the risk, 22 million. So that one is not supposed to be used either here or there. We have used that in computation of the risk liability and right of use asset. Okay, so below that we have dividends paid, inventory, account receivables. So we have account receivables. Account receivables. Account receivables is an amount of 63, 200. Yes, I think we have that. Then finally, we have long-term investment, which is a non-current asset. Then in the additional information number 1, we have the closing inventory. We have the closing inventory. And actually, this closing inventory, no adjustment for that. No adjustment for that. In fact, we can just record that here. No adjustment for that. So then we have note number 2 is about landed buildings. Note number 3, we have dealt with that is about leases. Note number 4, we will compute, I think, the interest. Okay. In fact, I think first of all, we can just, we don't have any other item, because I hope you can see in the trial balance, we have the bank balance in the trial balance, but that bank balance is on the credit side. We said, if it is on the credit side, it's upon you to know that is an overdraft. Being an overdraft, it will be recorded here as a current liability. So I think we have that. So then from there, what else do we need to do? We need to move and we record now the equity. So what we record at the equity is basically what we get from this statement of changes in equity. So we will have the ordinary share capital. And I think this ordinary share capital, based on what you're given in the additional information, that value will not change. We will also have the retained earnings. And also we will have the revaluation reserve. Revaluation reserve. So the values we get there is what we will bring here. So then from there, we proceed record non-current liabilities. Now the non-current liabilities, 1, we have this risk liability. The risk liability. The risk liability. Now the amount of risk liability which we recognize here under the non-current liabilities, who can be able to tell us from this risk amortization schedule, which amount do we recognize here? I think I've already experienced that. How much amount do we recognize here as a non-current liability? How much amount do we recognize here as a non-current liability out of these two values? out of these two values. Yes, if you check on what we did in that topic, this is what we recognize as a non-current liability. So 60, 182, 182. So that is one of the items of non-current liability we will have here. I think the other one should be the deferred tax. But remember, what we recognize here should be the deferred tax at the end, not the deferred tax which we have in the trial balance, but the deferred tax at the end. At the end. Then, still in this particular question, if you go back to the trial balance, the items we have up there, I can see somewhere or something given up there as 8% rolling stock. So 8% rolling stock, that one is an non-current liability. That one is an non-current liability, and I don't think the value for this will change. The value for this will not change. 50, 50. So do we have any other non-current liability? I can't see any other. I can't see any other. So finally, we record the current liabilities. Current liabilities, still we can start with the items in the trial balance. Below this 8% loan stock, I can see we have account payable. Account payable, the value for that is how much? Is 33,400. We just record there in case it has an adjustment, we do it. Deferred tax, that one should be recorded here. And then we have the bank balance. That bank balance we have said is a bank holding. How much is that? That is an amount of 12,500. 12,500. Yes, I think that's what we have. That's what we have. Now, take into account, we have now the skeleton. What do we need to do now? We need to go to the additional information as we make now the necessary what? Adjustment. So let's go to the additional information number one. So number one, we are given the closing inventory. And actually, you have said that that one should be used in the computation of the cost of sales. Number two is the current asset. And actually, that one do not have any adjustment. So that's why we have recorded that there. And also used in the computation of what? Of cost of sales. Number two, this point had some work. Let's go through it. We see what you're told. We are told that landed buildings were purchased in 1st November 2008. This is some time back, because if you check on the information which you're given here is for 2024. These assets were bought, acquired some time back in 2008. And you're told the cost of land at the date of purchase was 70 million. However, on 1st November 2023, 1st November 2023 is the start of the current year, because you can see this year ended 31st of October 2024. 1st November 2023 is the start of the current year. However, on 1st November 2023, landed buildings were professionally valued at 175 million and 80 million, respectively. And then you're told the estimated useful life of the building before revaluation was 50 million. However, the revaluation did not change the useful life of the building. So I think we can deal with those two assets. Number one, we need to determine the revaluation gain or loss. Sorry, before we do that, there is something we have forgotten to record here under the current liabilities. The risk liability. Remember, there is a risk liability to be recognized here, to be recognized as a current liability. And actually, we say it should be the difference between these two values. Can you give me that difference before I do away with that table here? Give me the difference between these two values. I'm told bank overdraft equally is 15,400. Yes. What is the difference between these two values? Because that is what we recognize here as a current liability. The difference between the risk liability in year one and year two. Year one, year two. I'm told by Evans says 16,529. 529. Is that what you're getting? 16,529. Yes, that is confirmed. That is what we recognized here as a current what? As a current liability. Now, having that, we can go to that point number two on revaluation of RAD, revaluation of buildings. So the first thing we need to do, can we go back to the trial balance? We go back to the trial balance, and I want us, we have the cost of those two assets from the trial balance. From what you're given in the trial balance, what is the cost of those two assets? The cost of land, the cost of buildings, Yes, from the trial balance, what is the cost of those two assets? Yes, so from what we have in the trial balance, we're given land and buildings at cost. Land and buildings at cost, which is 270. Now, if we go back to note number 2, we are told land and buildings were acquired back in purchased back in 2009. The cost of land back then was 70 million. So included here is the cost of land. The cost of land on the date of purchase was 70. So it basically means that the cost of buildings, is what? Is 200 million. That is the cost. Now, what we need to do, because these assets were revalued at the start of the current year, we need to determine the revaluation gain, or basically the revaluation what? Loss. We will determine this for individual assets. We start with land. So whenever an asset has been revalued, we compare two values. We compare the revalued amount with the cost. In case an asset is not depreciable, we know land is not depreciable. We'll compare the cost with what? With the revalued amount. But for buildings, we will compare the revalued amount with the net book value. So the revalued amount for buildings, as per note number 2, buildings were revalued at an amount of how much? We are told that the buildings were professionally valued at 175 million and 80 million respectively. So the revalued amount for buildings, for land, is it the one which is 175 million or 80 million? The revalued amount for land. The revalued amount for land is what? Is 175 million. So this is the revalued amount. We compare that with the cost. And basically this will give us what? Is it 105 million? 105 million? Yes. So the buildings, therefore, are revalued up, not the building, rather land, was revalued upward with 105. Now that one is part of OCI. So we come here and we say there was a revaluation gain on land of how for buildings. For buildings, we will not take the cost because buildings are depreciable. We will take this one, cost, which is the revalued amount, The revalued amount, first of all, as per that point, is how much? Is 80 million. 80 million. We compare that not with the cost, but with the net book value. So what is the net book value of the building? The net book value of the building will be this one, cost minus accumulated depreciation, which we have in the trial balance. Can you see the accumulated depreciation for buildings? Is it 60? Yes. So therefore, the net book value for buildings is 140. The buildings were revalued to 80 million. So meaning that the value for buildings reduced. The buildings were revalued downward because this one will be 140. The buildings were revalued all the way to 80 million. 80 million. So that means that buildings were, there was a revaluation loss of what? There was a revaluation loss of 60 million, from 140 all the way to 80, a revaluation loss of over 60. So that means that we have a revaluation loss here. Buildings, we have a revaluation loss of what? Over 60. And basically we record it here as a negative because it's a loss. Is what? Is a loss. Now, there is still something we need to compute here, the depreciation on buildings. But before we do that, also these two items will come here. So we have a revaluation gain on land. So that will go to which column? This column for revaluation reserve. So the revaluation gain for land, 105. We record it here as a positive. And then we have a revaluation loss for buildings. For buildings, we record it here as a negative 60. Negative what? Negative 60. Yes, negative 60, like that. Then what we need to do, we need to go back to that point and we compute the depreciation on buildings. Now, before we do that, there is something we need to do here in relation to getting the useful life. Now, can we go back to that point? And I want us to be together here because there is something which we are told here. We need to understand very well. So in relation to point number 2, we are told that these buildings, there is somewhere we are told that the estimated useful life of the buildings before the revaluation was 50 million. So when these buildings were acquired, the company estimated that the useful life will be 50 years. 50 years. And then you're told, however, can you go to that statement? However, the revaluation did not change the useful life of the building. It basically means that from the date now the building were revalued, we are going to compute the depreciation based on the remaining useful life. So remember, these buildings and land were acquired back in 2008. So they were acquired on 1st of November. That is the information you have in note 2, the first sentence. They were acquired on 1st November 2008. When were they revalued? Who can be able to recall? They were revalued at the start of the current year. The current year started 1st November 2023. That is when the current year started. So basically, we need to determine how many years do we have here. How many years do we have here? Our building at this date had been used for how many years? Such that from the date it was revalued, we need to determine out of these 50 years, what is the remaining useful life? And that's what we are going to use in computing the depreciation per annum for the current year. So how many years do we have between these two dates? Can you give me the number of years we have between those two dates? Tuko na miaka ngapi hapa? How many years do we have between those two dates? I'm told we have 15 years. I'm told we have 15 years. Is that the position? Do we have 15 years? Tuko na 15 years? I think so. We should be having around 15 years, because basically this year, mwaka, the previous year ilisha 31st of October 2023. That is when the previous year ended. Yes. So from this date, 1st November 08 to that, do we have 15 years? I hope, can you confirm? Can you confirm how many years we have there? You can literally count. You can literally count because we may be having 14 or 15. Tuko na miaka ngapi hapo? Naambiwa 15, naambiwa 14. Which is correct? So maybe tunaweza count. So mwaka ya kwanza hapa, remember, ilisha 31st of October 2019. We count from that date. We count from this date. Is that correct? Are we counting from this date? Yes. 2019, not 2019, sorry. 2009. 2009. Anna is saying no. When are we supposed to yes, 2009, 2009. So tutasema 2009, 2010, 2011, 2012, 2013, 2014, 2015, 2016, 2017, 2018, 2019, 2020, 2021, 2022, 2023. Yes, 2023. So how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I'm getting 15. Ama tumekosea? We can redo it afresh. 2009, 2010, 2011, 2012, 20, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. So tuko na 15 years hapo. Tuko na miaka ngapi? 15 years. So basically this building from this date to this date ilikuwa imetumika miaka ngapi? Ilikuwa imetumika miaka 15, 15 years. So at the date it was revalued, because we are told its useful life never changed, the remaining useful life need 35 years. So why do we need to do that? The reason why we need to determine the remaining useful life at the date the building was revalued is for us to be able to compute the depreciation for the current year. From the date the building was revalued, we will compute depreciation not using 50 years, but using 35 years. Using 35 years. So, and we compute the depreciation equally based on the new value. What is the new value of the building? The new value of the building ni miaka ngapi? Ni value gani? The new value of the building ni 80. And I hope those values that hatuko interchange. Is it supposed to be 80? Ama ndio ilikuwa 70? Because the value for other buildings 175 for land, and for buildings was, yes, 80. Yes, so it should be 80. It should be 80. But here's what is a question from the past paper, but whoever was setting this question, I think I changed is of figures, but no problem. Yes, because I think if figure you're going to require a building, and then this one I think was supposed to be for buildings, this one was supposed to be for art, but we work with that value the way it is given. Sasa, yes. This is a question actually from the past paper, but the person who was setting the question, I think he interchanged those particular values. So, kwa hivyo tutachukua the new value for the building, 80, we divide that with 35 years. We divide that with 35 years. So you'll see that we have some decimals there. So which is to the nearest whole number, we have 22, 86. 22 what? 86. So are you getting that the depreciation? Are you getting that depreciation? I've said, once we revalue an asset, and I think there is a similar question we did. Once we revalue an asset, we compute the depreciation using the new value. Using the new what? Using the new value. Using the new value. The new value is 80 million. So that is what you're going to use in computing the subsequent depreciation. Sasa, yes, that would be used in computing the subsequent what? Depreciation. Tuko pamoja? Yes. So though nimesema hii swali kuna makosa ilifanyika, I think the person, this is a question from another paper. So the person who was setting the question just interchanged those values. So tutawaka na ile value ya 2286. 22 what? 86. Sasa? Yes. So that's basically how we compute that. So that which was required in relation to that node, note number 2. So, and I think we are done with that. Though we will use that particular information here. In fact, before we move to the other point, can we compute this? We can first of all consider landed buildings. So the value for land which you're going to include here is the revalued amount. Buildings were revalued, sorry, land was revalued at this. So the new value for land which you're going to include here is not 70, but 175. That is the new value. Then for buildings, the new value for buildings is 80. But for buildings, we will less the depreciation for the current year. Remember, you say that once an asset has been revalued, we ignore the previous values, including the previous accumulated depreciation. So what we will consider here for buildings is the new value, 80, minus the depreciation for the current year only. Sasa? Yes. So let's go back to still point number 2. I want us to compute depreciation on plant. Yes, that is what I want us to compute in. Depreciation on plant. The depreciation on plant, we are told will be what? The depreciation on plant, we are told, will be 15% using the reducing balance. Reducing balance, we compute depreciation based on the net book value. 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 So we take what? We take 15%. The net book value is equal to the cost. What is the cost of plant in the trial balance? It is basically 156,000. 156 minus accumulated depreciation. Accumulated depreciation for plant is 26,000. So the net book value is 130. We get 15%. We get 15% of that. 15% of 130. So, and what are you getting here? 19.5. Yes, 19.5. 19.5. This one will be included within the cost of our sales. That basically what you're told in note number 2, the last paragraph. Depreciation had to be included under the cost of sales. Yes, then finally here we can deal with the plant. So for the plant, tutachukua cost ya plant. Actually, we can just do this. For plant, we take this one, 130, because that is the cost minus accumulated depreciation. We take this, we just less the depreciation for the current year only. Sasa? Yes. So that will be plant. Tuchukue 130 minus 19.5. And actually, we will be done with that because we don't have any other item of PP. So can we first of all get the final values here before we move? So we have 175,000 plus 80,000 minus 2286 plus 130 minus 19.5. And basically I'm getting 363, 214. 214. Is that what you're getting? Is that what you're getting? Yes, confirmed. So we are done with the point number 2. We are done with point number 3. Let's move to point number 4. Point number 4, we are told the 8% loan stock were issued on 1st January 2024, and the interest is payable 6 months in arrears. So what is important is for you to note the date when these loan stock were issued. These were issued during the current year, and they were issued 1st of January 2024. When is the current year ending? The current year ended on 31st of October 2024. So if you count the number of months from the date they were issued to 31st of October 2024, hapa tuko na miezi ngapi? Hapa tuko na miezi 10. So if we have 10 months, it basically means that the interest the company was supposed to pay on this loan stock should not be for the whole year, but rather should be interest for 10 months. But there is something equally which you are told in that point, that the company pay the interest over 6 months, or the interest is payable 6 months in arrears. So the company pay interest of 6 months. After every 6 months, the company pay interest. So automatically, when this year was coming to an end, because we have 10 months here, the company had only paid the interest for the first 6 months. So it means that there is part of the interest which was not paid, and that one should be added to this finance cost, because the interest expense for the current year, in addition to this, should be 8% of the year value, 50,000, times 10 months out of 12. But we are saying that what the company had paid this one, this has to be for 6 months. That's yes. So because if you take 8% of this is 4,000, half of 4,000, or 4,000 times 6 over 12 is 2,000. So the company had paid interest for just 6 months. Is that what we recognize here? What we recognize here is the interest expense for the current year. For the current year, which should be for 10 months. Sasa? Yes. So this will give us what? We have 8% over 50,000. Yes, 8% over 50,000, which will give us 4,000 divided by 12 times 10. So that is 33. 33. Yes, 33. So meaning that the company had, out of this, the company had paid 2,000. So the amount which was not yet paid is 1333. So that amount not yet paid is part of the current liabilities. So we will say there was accrued interest on loan stock, which is part of the current liability, 1333. We recognize it there as a liability, and also we add it to this, plus 1333. So we have so many decimals in this question. Yes. So, but that one should be the correct treatment. So we are done with that. Let's move to the last point, is about tax. Let's move to the last point, and then we get the final values. So we are told that the income tax for the year which ended 31st of October 2024 is estimated to be 28.3. 28.3. So automatically in this question, we don't have any over or under provision of current tax in the previous year. So that value do not have any adjustment, no adjustment. That is the current tax. The current tax. So the current tax is what? Is 28,300. We recorded it as a negative. And then we are told in the same point, the deferred tax provision as at the end of the current year was to be increased to 14.1. So it basically means that the deferred tax at the end of the current year will be increased to 14.1. So that deferred tax provision at the end of the current year is basically what we recognize here. In other terms, the deferred tax at the end of the year, because we said this deferred tax which we recognize here as a liability, this money which is set aside from the company's profit to be used in terms of paying the taxes in the future. So the deferred tax at the end of the year will be increased to 14.1. Then if you go back to the trial balance, how much is the deferred tax in the trial balance? Who can be able to see the deferred tax in the trial balance? The deferred tax in the trial balance. the deferred tax in the trial balance. The deferred tax in the trial balance is 12.1. Now, remember what we said is that what we account for as far as the deferred tax is concerned during current year is the increase or the decrease. The deferred tax at the start of the year, that is the deferred tax liability at the start of the year was 12.5. The deferred tax at the end of the year is 14.1. So what do we have here? We have an increase. We have an increase of what? We have an increase in deferred tax or an increase in provision for deferred tax of how much? Because that is what we account for during the current year. So this is an increase of what? Is it 24 or Tito? I don't think so. Oh, yes, it should be 24. It should, 24 AMA 16. It is 16. We have an increase of 16. So an increase in deferred tax liability, we said, is known as what? Which name is given to this? Increase in deferred tax liability. Increase in deferred tax liability. Tulisema jina hiyo ni gani? Which name do we give to, or Tito is not a liability? Which name do we give to an increase in deferred tax liability here when preparing the income statement? Which name is given to that? We did the same in the other question which we did in our previous class. Increase in deferred tax liability. We said you just need to recall how were you accounting for an increase or a decrease in a provision for bad and doubtful debts. That is what you just need to remember. An increase in a provision for bad and doubtful debts, that one you are accounting for it as an expense, an increase. So a decrease in provision for doubtful debts, you are accounting for that as an income. And therefore, we said an increase in deferred tax liability, that one is a deferred tax expense here. An increase is a deferred tax expense. But if it was a decrease, check the other question which we did. I think in the other question which we did, we were told the deferred tax liability was to reduce. If it was to reduce, I said that is a deferred tax income. So because we have an increase there, this is a deferred tax what? Expense. So the deferred tax expense is the increase, which is basically how much? Is 1,600. And because it's an expense, we record share that as a negative. And I think in our case, we are done. So what we just need to do is now we get the final values. We get the final what? Values here. So let's do that because I think we are done. So the revenue will not change, 278,400. So let's get the final figure for the revenue. For the cost of sales, cost of sales, we work out that. We have 37,800. We compute this together. We have 78,200 plus 78,200 minus 43,200 plus 18,347 plus 22,86 plus 19,500. 19,500. And basically that will give us what? That will give us 112,933. 933. That is basically what I'm getting. So please confirm whether you're getting that value. Is that what you're getting? Yes. So having that, we move basically to, in this case, we said some of these values, like the gross profit, you may decide not even to compute that because we said what is marked, ni your revenue, na your cost of sales. So gross profit hata unaweza achana nayo. So this income from investment here in adjustment. Na tulisema the beauty with this is that this value hata ukiacha hapo bado itakuwa marked. Sasa hata ukiacha hapo bado itakuwa marked. Sasa si lazima uirecord hapa mwisho. Tuko pamoja, Evans? Hiyo figure hata ukiacha hapo, it will be what? Itakuwa marked up. Sasa distribution haina adjustment. So let's just record it here. And because it's an income, is an positive. When recording an expense, lazima uweke kama negative. Otherwise ukirecord kama positive, hiyo inakuanga wrong. Lazima uweke kama negative. Admin, no adjustment. Finance, we get the final value. We have 2,000 plus 69.74 plus 13.33. That will give us 10.307. So no need of even computing this value. At easy, no need of computing those values because all these are not marked. So what we said will be marked here is the figures as that we record up. So these are the figures to earn you the marks. Easy figures, easy. These are the figures to do what? To earn you the marks. These figures here. Sasa, yes, so those are the values which are marked. So then we do the same here. Is there anything we need to bring here? I think what maybe can bring here is the profit after tax. We no need of computing that because that will give you a lot of work and which now will affect this. No need of doing that because what will be marked here are these equally these entries. These entries we have there. Sasa, yes. So let's move to our statement of financial position. And I think we have the value for PP investment, long-term investment, right of use, receivables no adjustments. Na tumesema hiyo value hata ukiacha hapo ya receivables bado itakuwa marked. Sasa hiyo value hata ukiacha hapo itakuwa marked. Acha tuipeleke huko mwisho. Equity here we will start with the share capital. Share capital will not change. There is no transaction which affected share capital, it remain 150. Retained earnings hii tunaweza achana nayo, si lazima tu compute kila kitu. That basically what we said. Revaluation reserve itakuwa this minus that. Revaluation reserve the net amount itakuwa 45,000 45,000 45. So we already have the lease liability, the deferred tax, this one, account payable no adjustments 33,400, bank overdraft 15,400. Na tumesema hizi figures hata ukikuja uziache hapo zote zitakuwa marked. Sasa, yes, that's why December I've insisted on the need of that skeleton because in some instances you may not be having time even to go through the additional information and you make those adjustments. Sasa, yes, but tumesema once you may come up na hiyo skeleton, hizi values umezirecord hapo, they will still earn you marks. Sasa, they will still earn you marks. They will still earn you marks. So that is it. That basically what was required as far as that question is concerned. It was a very good question, though. I'll say that this is a question which came from another question which was examined some time back. So the
Norbert? Ambuche, Norbert, can you hear me? Are you able to hear me? Norbert and Getich, confirm if you can hear me. Yes, I can see Ambuche is able to hear me. Norbert, confirm if you can hear me from your side. I'm waiting for Norbert to confirm if he can hear me so that we can proceed. Good. Norbert is able to hear me, so that means we can proceed. The rest can join us as we move along. So I don't know if maybe we give them 3 minutes or we just proceed. We are at 12:12. I don't know if you can give them these 3 minutes or we just proceed. Now, what do you think? Norbert, and do you give them up to 15 or we just proceed? Okay, we're going to proceed. We're going to proceed, and I want us to look at this paper, December 2022. And this paper, we had started looking at question 1, and then we stopped there. So we are on question 2, basically. And we looked at question 2A on Thursday, and then we stopped there. So I want to proceed with the paper and look at some of this question and subsequent questions that we have. Now, the question 2A is asking, identify 5 reasons why business organizations should write a business plan. So business plan is basically a document that tells us more about your business as an organization. So this question is just asking, how can we be able to, what's the reason of a given organization writing a business plan? That's what this question asks. Now, first one is to provide direction and focus. So basically, with a business plan will tell us about your vision, your mission, and we tackle the question. Okay, thank you. So I think we are supposed to go to B. Ambuji is saying that we have tackled the question, so there's no need of repeating it. We are supposed to go to B part of the question. Okay, so I think we're supposed to start at this point. Ambuche and Norbert confirm. Did you tackle this one also? Okay, good. So that means this is where we're supposed to start. So let's just proceed here, where we want to look at basically question 2B. It says organization success is dependent on interaction and interdependence of internal and external system components. With reference to the above statement, describe 5 components of organization system. So a company is a system. When we talk about, for example, a system is an interconnection of various parts which function or functions as a unit. That is basically called a system. For example, from the biology, you talk about breathing system, digestion system, maybe excretion system. So basically, a system is several parts which work. So as a company, what makes a company basically? What makes an organization? So one of the major components of a company or organization input component. So for a company to be able to operate adequately, there must be some inputs that come from the company. Now, say that inputs refers to resources that an organization uses to produce goods or services. This includes human resource. So as a company, the first input or the inputs that we have, another one is called what? Is called human resource as an input. Human resource is a very good, means what? As a company, you need employees. Human resources are basically the company. Human resources are basically the companies or the employees that the company has. We call them human resource. Service as what? As human resource, which is basically the workforce or the employees of the company. Raw materials, you need printing materials, you need the raw materials we use. Information. So information is also an input basically, and information is an input because of the information. Sometimes you want to produce goods or provide services. The first thing is to get more information. Information that you are gathering is an input. When you're doing market research, that you're gathering that information, and that information becomes what? Input, because it helps you to produce a product that is in line with what? The needs and wants of the customer. And then you also have the capital. Capital basically includes financial capital or maybe machines and technology. Effective management of inputs, essentially what? Basically, if you're able to manage those inputs, then you're able to what? Come up with what? A very good final product that you can be able to what? To sell to the customers. Now, once those inputs come to the company, they're supposed to be processed. Process is about converting them. You're supposed to convert inputs into output. That's now the second part, which is called what? Process component, because those inputs have to be processed or have to be used to what? To be able to what? Produce an output. So the process component becomes very important because every input must be processed in order to what? In order for us to what? To come up with the output. So what is this process component? So that this includes all the activities that transform inputs into output. So anything that in production and operation, we call them what? We call them transformation process, basically. So that this includes all activities that transform inputs into outputs. Examples include manufacturing. So if we get an input, when we manufacture means we are changing that input into output. So basically, manufacturing is a process of what? Of converting input into output. That one we know. The second one is service delivery. For example, when somebody comes and you carry out, you can provide a service. For example, learning. Learning is a service. You come here when you don't know much, and then with the time you know more. So basically, that is also a very important aspect of the inputs that we talk about there. And then we have the output components. So once we have been able to, so basically, process here includes manufacturing, include processing, include assembling, and also transformation. Maybe in terms of knowledge, somebody comes in class when they don't know much about a given aspect. And then when they leave the class, they know more. That's called transformation. So that service delivery, decision making, and collection pressure. Efficient processes ensure maximum value of delivered from the source. Basically, if you have a good transformation process or a good process component, then basically you're able to what? End up coming up with what? A very good product. You will end up what? Coming up with a very good and a very important product. Then the third components is called the feedback loop or the feedback components. Basically, our transformation, when you're doing production, we do production with the intention of what? Of serving the customer. So customers will give you feedback whether the service was good or the service was bad, the product was good, the product is expensive, or the product is not meeting. So basically, feedback is very important. Every company must have a feedback loop whereby everything they're doing, they're able to get feedback from the customer or what the customer thinks about them or what the customer feedback can be complaints, can be recommendations, can be compliments, can be suggestions. So basically, as a company, be open to what? The feedback from the customers. So that's called the feedback components. Then number 5 is the environment components, which is basically talks about what? External systems. So a company does not operate in what's called isolation. A company operates in an environment. So basically, you'll find that what? External environment also plays a very major role. Now, we say here that this includes economic, social, legal, and political forces. outside the organization that influence its operation. We call them the Prestel, we call them the what? The Prestel factor, the political factor, economic factors, legal factors, political. So basically these factors, they operate outside of the organization, but they affect the operations of the organization. Very important to understand. So basically, those ones are the five components that affect the system of the organization, or the components of the system of the organization. I believe that is well understood. Now, question 3A is asking, explain 5 causes of a project failure. These are very important and a very interesting question. When somebody asks you to explain 5 causes of a project failure, if many a times, if you're given a project, projects sometimes fail. Now the question is, what are some of the aspects that, or factors that what, or some of the causes that what can lead to what, a project not being able to what, to meet an objective? A project could be, you're given a project to do a building, a training project, could be a construction project, but basically, what are some of the factors that can lead to what, a project failure? That is what basically we are asking as individual. Now, the first thing is what's called poor planning. They say that failing to plan is planning to fail. So poor planning plays a very important role. Poor planning plays a very important role, a very vital role in ensuring that we are able to achieve. So failure to clearly define project scope. So planning involves basically defining project scope. What do you want to do? That's the project scope. It outlines project scope. Talk about objectives. What are the objectives of the project? Talk about timelines. When are we supposed to finish the time? We could talk about timeline. We talk about resources that we need. Are we able to put them in place? So basically, that's a very important aspect whereby you look at timeline in terms of when are we supposed to start and when are you supposed to end. So all those, that's the first factor that what can lead to a project failure. The second factor is inadequate risk management. Means you know that there are a lot of risks that are you're going to face or you're going to be exposed to in a project. A lot of risks that basically you will be exposed in doing a project. Now, if you don't plan for the risk, then some of these risks can affect your ability to achieve the success or ability to implement the project. Now, say that or fail. Ignoring potential risks or failing to develop mitigation plans can derail projects when unforeseen events occur. So if you don't have a risk management mechanism, some risk can come and take you down. Some risk can interfere. Some risk can affect your ability to be able to achieve. So basically, poor risk management, where you don't put plans to manage any risk that can happen, then basically you may end up failing as a project. The next one is lack of stakeholder engagement. Some projects fail because what? Some projects fail because some stakeholders are not involved. You have seen people demonstrating that this road is supposed to build here, but they're taking a long time, we are not being paid. Or you've seen people that this thing is poisonous. So this company is going to emit dangerous gases here and go to affect. So basically, what you need to understand is that some of these projects, we need stakeholder engaged. For example, you can set a project in a given area, you have not involved the government. They're supposed to give you license. So basically, when they come, they shut down the project. So we say that projects often fail when stakeholders are not adequately involved in planning or decision making, lead to resistance or unmet expectations. So some of these stakeholders may frustrate implementing a project, or they may just try to ensure that you don't achieve the objective. So that is very important. And then number 4 is insufficient resources. Basically, talk about financial resource. So a lack of resources is very important. When you lack financial resource, human resource, capital resource, basically, that even time as a resource can affect can lead to your failure. So say that projects that are underfunded. Underfunded means what? We talk about lack of financial resource. So projects that are underfunded or lack qualified personnel, that's what human resource. So we talk about underfunding, which is what? Lack of financial resource. Then Lack of qualified personnel means you don't have people with the skill and knowledge to carry out the projects. Tools or materials, when you don't have adequate tools and materials, this one can lead to what? A project failure. And the fifth factor, basically, or the fifth cause of business failure, or project failure, is basically ineffective communication. Some of these projects, some of these multi-billion projects require constant communication on where you are, where you've reached the project. So basically, some of these projects, they fail because there's no communication. You don't involve people, what's happening, you don't involve them. So that communication breakdown between project teams, managers and stakeholders can result in misunderstanding, misaligned goals, and lack of coordination. So if you don't communicate well, then you're likely to what? You're likely to fail as a project. If there's no good communication between the team members or project team members, between managers and stakeholders, then that can lead to what? That can lead to a very big problem of the project failure. Very, very important. Now, on that question, are we good? Is that question good? Are we good on the question? Is it clear? Or I need to explain further? Are those points clear? Or can you be able to add? Can we be able to add something? Which other factor do you think can lead to project failure apart from these ones? Which other one do you can lead to project failure? Which other factor do you think can lead to the project failure? What else can lead to a project failing? Which other factor can lead to project failure? Demotivated employees as a result of not engaging them. Yes, demotivated employees can lead to project failure. When employees are not motivated, then basically they can frustrate implementation of what? A given project. What else can lead to project failure? Which other factor do you think can lead to, what can be another cause of project failure? How about poor management? Yes, leadership style or management style. Poor management can lead to project failure. What other? There's something called lack of, we call them acts of God, 𝐻𝐍𝐿. Basically, there are some policy shifts. That's very good in getting a very good answer. Policy shift, basically. If you see, there's some projects that were being done by maybe the previous governments, and then a new government comes with different policy. Those projects that were not in line with what the current government does, basically, may end up failing because now funding will not be what? Funding will not be given to those projects. So basically, they're likely to face. And then aspect of what? Aspect of other cause that I think like, we call them these major acts of God. Things like earthquakes, things like flooding. All those one can frustrate what? Implementing a project. What happens with Trump and USAID? That's basically, yeah. So you see, Trump said that USAID is being used politically, or USAID does not what help in achieving what the US as a country wants. So they said is what? In fact, he just came in and said that what is continuing its operation, and by that, within no time, just went to their website. Website is not there. So basically, that one affected what? So those are some of them. So if, for example, you had a project in this country that was being funded by USAID, those people are gone. In fact, there are people that have lost jobs, very senior members of working in the USAID. USAID was one of the most profitable, or the best, one of the best employers here. But now, after USAID went down, then some people became jobless, basically. So those ones are very important aspects that we look at in terms of what? In terms of factors that can affect implementation or projects failure. I don't think there's something which have been written. So lack of accountability, basically, that's what happens. Really, the local projects here, they're failing because of lack. We call them white elephant projects. Find that a building, they were supposed to build a stadium. Now there's just some structure, a few very funny structure there, and the stadium was supposed to be built there. So basically, all those factors affect project implementation. So please look at. Then, and many others. Thank you for those additional points. Those are very, very good points. Next question here is asking, the next question that we have here is asking, the next question is asking, as a function of management, evaluate five principles of organizing. So basically, organizing is one of the major functions of management. We call them one of the primary functions of management. If you're a manager, then basically, organizing is one of the major activities that you will be engaged in. Very important. Now, let's look at some of the principles of organizing. So what are some of the guidelines when you're organizing? What are some of the major guidelines that you have to look at that? Now, the first one is division of work. So in organizing, you must divide work. You are supposed to do this one, you do this. So basically, that's very important. So organizing becomes very important. So division of work. So in organizing, you have to tell people that, okay, you are the marketing department, your accounting department, this will be, so basically you divide work. The number two is what? Authority and responsibility. So basically what does that mean? Is that each employee should have a clear understanding of their authority. What is the authority level to make decisions and be held accountable for their actions? So in organizing, you must give people work, give them authority, so that they're responsible for non-performance of those work that you gave them. Then number three is unity of command. So in organizing, you must be able to tell people that this is the senior most person who is following that basically. So that an employee should receive orders from only one superior to avoid confusion and conflicting instructions. So in organizing, you must organize your company in such a way that what? The junior employees can only receive orders from one individual, because if they receive orders from more than one individual or centers of power, then basically some of them may give conflicting instruction and the employee may feel confused. Then number four is span of control. So in organizing, In organizing, basically, there's something called span of control. You must put some people under a single individual, so that there is a limit to a number of subordinates a manager can effectively supervise. A proper span ensure effective communication. So basically, in terms of span of control, you should try to ensure that what in organizing, maybe a department, you should put the right number of people that can be managed. So span of control means the number of people under a single manager or a single management. That's basically called span of control. For example, if I'm the head of department and under me, I have 20 employees, then my span of control is 20. So basically, span of control means what? The number of employees which are being supervised by what? By one individual. So in organizing, you must ensure that what? You have the right span of control. That what? You don't give somebody so many people that they're not able to supervise well. And then coordination, basically, in organizing, you must ensure that there's coordination between members or among members. So that the efforts of all departments and individuals should be harmonized to achieve organization goal. Means what? In organizing, you may be organizing people in different units or different functions, but at the end of the day, they must work together to help what? Achieve the company objective or the overall objective of the company or the function. That's what should be done. They should ensure that what? Although we are doing different things, but ensure that there's an aspect of what? Of coordination or collaboration to achieve the objectives. So that is some of what? Some of the functions of management, the 5 principles of organizing. Sorry, those are some of the principles. So if you're organizing, you must divide work. You must have authority and responsibility, give the employees work to do, give them authority, and then unity of command. You must ensure that in organizing, you put one person in charge, so that instruction come only from one person. And then span of control, you must ensure that what? You put the right number of employees under, and then coordination. So basically, those are some of where as 5, but there could be more. So principles of what? Of specialization. What about it? When we talk about principle of specialization, what do you mean? Is it a question or is one of them? It's one of the principles of organizing. One of them. When we talk about principle of special means what? Specialization and division of work. When you're dividing work, basically means you're putting people in the work they're special. Basically, that can also work. Whatever you're saying is also true. Means in organizing people, ensure that what? Everybody, you give them a job which they are qualified to do. They have the skills, the knowledge, and the experience to do. That is very important. So understand that one. That one I understand very, very well. Any other principle? Any other principle? Any other principle of organizing? Any other one that you can think is a good principle for organizing? Adaptability to change in the environment, very true. Because the company is not static. The environment which the company operates is not static. It is dynamic. It keeps on changing from time to time. That means that even organizing must keep on changing. So there's an aspect of what? Of adaptability. You need to adapt. When things change also, in terms of organizing, organize to be able to what? To meet the changes in the environment. So that is also very, very important that you look at that. So the principle of adaptability, you must be able to what? Adapt to the changing environment so that at least we are able to what? We're able to ensure that we change with the environment. When the environment change also, we change, very important. So those ones, Wendy, okay, flexibility, oh, good. And then all of those ones are right, basically. You must be flexible in organizing. Don't be somebody. Balance. What do you mean by balance? Balance is not complete. Resource allocation, basically, in organizing, you need to ensure that what you allocate resources optimally. That's true. Balance. What do you mean balance, Wendy? Balance. That point is not complete unless you explain to me what that balance means, or balancing what? Is it work-life balance, or what are we balancing? So if you tell me what you mean by balance, then basically, I mean, when I just like balance, then I know if you have to explain, you'll let me know what you mean. But now I was supporting the point of flexibility. Okay, that's how good. Thank you for that. Then now the question 4 is start with some illustration there. And this is a very good illustration because it's a current illustration. It talks about COVID-19. Talks about coronavirus. COVID-19 is also baptized as coronavirus. So say that, sorry, I don't know what happened. Why is this thing writing? Need to wrap this. Now, there's this question. Say that Jack Jim, a well-renowned national change agent, means is somebody that can help the company to what? Effect change. Joined PQX Company Limited as the Chief Executive Officer when COVID-19 struck the world in 2020. In his first week after appointment, he called a meeting for the top-level managers in the company to brainstorm on the changes in PQX Company Limited in order for the company to remain afloat. So this guy came when the company was facing a very big challenge in that we have COVID-19 here, but he wanted to ensure that the company remained profitable, or the company remained in existence, even with the tough economic terms then. Now, required, explain the term change agent. When you talk about say that somebody is a change agent, what do you mean? So the first question is what? We are required to explain the term change agent. Or no, who is a change agent? That is what to do first. That a change agent is an individual or group that facilitates what and drives transformation within an organization. So a change agent is just an individual that what that drives transformation. A change is basically transformation. So if you're somebody, you can come to the company and drive transformation or change, positive change basically. We call you what? A change agent. So basically, there are people that can also come and drive negative change. There are also people that can come to the company and the company start going bad, start doing badly. So they also change agent, but now they're bringing negative. We talk about a positive change here. So that's called a change agent. To continue, we're saying that they're responsible for initiating, managing, and implementing changes to improve performance. Look at, they're doing change. When they're doing change, their change is positive. That's why it talks about what? Improve performance, increase competitiveness, and respond to external challenges. A change agent challenges status quo means they want things to move ahead. They don't want people to be feel comfortable where they are. They need some new changes. Advocate for new ways of doing things and support them or action through the transformation or transition process. Basically, that is who we call a change agent. In exam, if we were just as an individual or group of people, that's what what a drive transformation within a company to achieve this objective, then basically that's what we're going. That's it. Then next, Roman 2 of question 4a is asking, analyze 3 issues that might have been addressed. So in that time, it was time of coronavirus. So you're told that he called a meeting to ensure that the company remains afloat. Now you're asked, what are some of the 3 things that they might have addressed in this meeting? Number 1 is business continuity plan. How do we continue operating even with the coronavirus? That is one thing that was in his mind. Now, I'm given a company here. We're in a time when we have coronavirus. What can I do or what can we do, or which plan can we put in place so that we become what? We become afloat. So that the meeting likely discussed on the folks, how folks would continue operations amid COVID-19 disruptions, including remote work. Say that, okay, some people don't need to come to the office. If they're able to do their work through their laptops or through computers at home, let them work from home. Do remote work, digitalization, maybe we can start digitalizing things, customer can be able to access us, can be also, and supply chain adjustment. Supply chain basically means movements of goods from the point of production, the point of consumption. How can we be able to watch to ensure that irrespective of the coronavirus, our customers are still able to get their requirements when and as needed? That is one thing that they need to look at very, 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 very carefully. Now, the next thing is financial stability measures. How can we ensure that we are going to be still financially stable even with the prevailing market condition? That's basically, we need to look at that. Now, what does this mean? That they might have discussed cost-cutting strategies, liquidity management, and exploring new revenue streams to stay solvent during the crisis. Number 1 is what? Cost-cutting strategy means what? Which aspect of this company can we be able to cut some costs so that we don't spend much money? Which areas can we use to cut costs? Liquidity management. How can we manage our cash spending, basically, buying, acquiring? Then exploring new revenue stream. How can we be able to how can you get more money? How can you get more money right now? That's called what? That is called revenue streams. For example, there's some companies that what they can do is they can decide to, let's say, for example, you're a manufacturing company, you're manufacturing goods. They say that now it's coronavirus. What are people now? What are the demands now? One of them is mask. If you're able to produce mask, start producing mask. Nothing should be sanitizers. Are you able to produce? So basically look at what can you produce, or what is the demand then? If you're able to produce a company, then start. Then number 3 is health and safety protocol. That's very important because coronavirus was very deadly. So we need to ensure that have we put enough health and safety measures in place to ensure that in case one of us maybe in case one of us false ale. How can you be able to handle it? Do you have enough resources to handle such kind of issue? That is basically something that you have to discuss about. So see that ensuring employee safety through implementation of health guidelines and sanitization and employee wellness programs would have been critical. So basically, they can be able to look at that aspect or look at that aspect very, very well. Now, those are some of the three issues or three agendas that what they might have discussed in that area. Now, then go to B part of that question. Question 4B is asking, evaluate 5 strategies leaders might apply in organizations to increase their leadership influence. Basically, it's about power. What can you do to ensure that what you are able to amass power, make people believe in you? So that's called, there's a question, I think a suggestion somewhere. Logistics, since movement was also restricted, the country to become more challenged to survive. Okay. Innovation, idea, and what? Basically, those are also very good points. Ambuche, those are very good points. Innovation, they must look for example, can we, instead of having this physical meeting, can we be having what? Online? Can we meet via the Zoom, via all those things? So basically, the aspect of innovation was also so those are very good points. Ambuche, thank you for the points. Now, this question is asking, evaluate 5 strategies leaders might apply in relation to increase their leadership influence. Influence is basically power. This question is just asking, how can leaders increase their power? Influence is basically power. So what they're asking, what can you do as a leader to ensure that you retain your power or you become powerful, basically? Number one is what? Leading by example, what's called modeling behavior. That's a very powerful tool to use. People should look at you, and in looking at you, they should be able to what? They should be able to see, that you are a person of stature. So leaders increase influence by demonstrating integrity. People look at you and say that what? This, our manager, is a manager of integrity. It does not involve in any unethical behavior, accountability, and commitment. Employees are more likely to follow leaders who embody the values they promote. So if you talk about integrity, practice it so that other employees can see that what our leader is committed. He talks about integrity and is one of the people of integrity. Is one of the most people with the most integrity here. Then number 2 is effective communication. Basically, the more you communicate with the employees, the more they become, the more you influence them. You communicate, give them, discuss with them. So basically, you become so clear, transparent, and consistent communication build trust and fosters alignment between leaders and teams, enhancing influence across. So if you're able to communicate to your people, in case there's an issue, you address the issue very well, then basically your people are going to trust you. Your people are going to ensure that what every time you talk about an issue, they're able to ensure that what that issue is addressed in amicable manner. That's one thing that what you'll be able to achieve very well in terms of what? In terms of increasing your influence there. The next one is on empowering employees. You don't lose power by empowering people. Some people feel like when they empower employees, now they become powerless. You don't lose power by empowering others. So delegating authority and involving employees in decision-making fosters ownership and loyalty, increasing the leader's impact. So basically, if you empower employees feel like what? You trust them. You're able to give them some tasks to do. When you empower employees, they feel like what? You trust them with work. And that one makes you what? Makes them respect leadership. And then number 4 is building relationships and networks. So strong interpersonal relationship with peers, subordinates, and stakeholders helps leader gain support and collaboration, boosting their influence. So basically, build relationship networks. So we call it what? Build a good rapport or build rapport with the people around you, stakeholders. Talk about employees, talk about shareholders. Ensure that you have a good rapport with everyone around you. By doing that, basically, you'll be able to what? Expand your influence. Next one is visionary leadership. For you to be able to, for people to be able to look at you as an influential leader, you must show what's called influence. We talk about influence here. And what do we mean talk about influence? We say that what leaders who articulate compelling vision, inspire and motivate employees, aligning their personal goals with them. So basically, if you are somebody who is visionary, you tell them what you're going to achieve, and you also ensure that what in the employees trying to help you achieve your objective. Also, they also achieve their personal objectives. So basically, that is another way in which what you can be able to what you can be able to exert influence, or you're able to what influence employees. Very, very important that you understand that. Next one, number 5, question number 5, say that describe the 𝐎𝐻𝐂 change management model. So 𝐻𝐂 is one of the models or tools that you can apply in managing change. If you want to bring change in a given company, you can decide, okay, let me use the 𝐻𝐂 management model or 𝐻𝐂 change management model as a tool to help me what implement a change. So the question is asking, describe the 𝐻𝐂 change management model. How do we apply 𝐻𝐂 in ensuring that what we implement a change? That is what that question is asking. Now, the first one is 𝐻𝐂 is basically an acronym. You see, I was talking about 𝐻𝐂. 𝐻𝐂 is an acronym. It's a short form. So that A stands for awareness, D stands for desire, K stands for knowledge, A stands for ability, and R stands for reinforcement. So you apply that, and then you end up what? Having 𝐻𝐂, or you end up now understanding what 𝐻𝐂 is. 𝐻𝐂 is just an acronym. So let's look at how you can use 𝐻𝐂. So see that word. 𝐻𝐂 model is a goal-oriented framework that guides individuals and organization change. They guide individual and organization change. It stands for, so this is what 𝐻𝐂 stands for here. A stands for awareness. So before you implement change, you must know, you must be aware of where you are as a company. You cannot implement change if you're not aware. So first thing is what? You must be aware of where you are as a company, called awareness. So you say that understanding the need for change. Why do we need to change? Need for change. Individual must recognize why change is necessary. So basically, awareness means you must tell people that we need this change. And the reasons why we need the change are A, B, C, D. So basically, awareness is very important. You must let people know that we want to bring a change and the reason why. So you communicate, inform people about what they need for change. Then number 2 is desire. So the motivation or willingness to participate in and support the change. Desire means what? You must be sure that what? There must be some willingness or motivation to participate. Every employee must have the desire to or motivation to participate in ensuring that the change is implemented well. Then knowledge, knowing how to change, including training, education, and information on how to implement change. So basically knowledge, people must have the knowledge on how the change can be implemented. And knowledge can only be brought through training, education, or information being given on how the change can be done and how the change is important. And then number 4 is the ability. So that means the skill and behavior required to implement the change effectively. So some people may have to be taken back for training so that become change agents. Then the last one is reinforcement. Sustaining the change through recognition. Recognize those who are working hard, and then rewarding those who are meeting their objectives, and continuous support to prevent what? Regression. So basically, that is how we apply 𝐻𝐂 as a change management model. So you can decide that if I want to implement change, I'll just go with the 𝐻𝐂 principle or the 𝐻𝐂 model, whereby you now try to apply it, be able to what? To be able to apply it, to be able to to be able to achieve a certain objective or a certain goal. Any question? Any question on 𝐻𝐿𝐿 model of change? Any question on the 𝐻𝐿𝐿 model of change? Any question on the 𝐻𝐿𝐿 model of change? Ambrose does not have a question, so let's proceed. Question B is asking, explain 4 challenges associated with group decision making. It's very true. If you say that you want to make a decision as a group, what are some of the challenges you like to meet? Number 1 is called groupthink. Groupthink is a case whereby you don't want the other members to feel like what you're sabotaging or you're against them. So you end up making a decision, but you may have a different opinion. But because you don't want to disturb the unity of the group, then you just accept. Number 2 is time consuming. In group decision making, is when they're meeting. Let's say you have like a people like 50. For them to agree on one thing, it will take time. Some will be giving, opposing, some supporting. So reaching a consensus may take time. So we say that group decision making often takes longer due to discussions, debates, and need for consensus. So meeting those aspects is very, very difficult. So you may end up taking a lot of time. And then number 3 is what? Dominance by one member. There's some groups whereby there's a member there that is very powerful. He's dominating, maybe because he's a manager or because he's a HOD. So basically, he's very dominating. He tries to dominate almost every aspect. So that strong or vocal personalities can dominate discussion, limiting inputs or of quieter but potential insightful members. So if you have a group whereby there are some dominant people, they want to talk every time, they don't give chance to quiet people. There may be some people who are very quiet but are very knowledgeable. So basically, that is something that also we look into. And then number 4 is conflict and disagreements. Anytime you want to decide something and you have more than one person, then basically there's bound to be some conflict there and also some disagreements. Those ones are bound to happen. Conflict and disagreements are bound to happen. Now, what do we mean here? Say that differing perspective may lead toward interpersonal conflicts, stalling decision-making, and affecting group cohesion. That's very true. You may end up having conflict. People don't agree on a given point. Some people have got personal vendetta to settle. You end up You may end up not agreeing. You may end up taking too long, and also you may end up making a wrong decisions. That's all. That thing we're going to look at very, 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 very carefully. So that is it. Then the C part of that question is asking. The C part is asking, summarize 6 benefits that may accrue to an organization from registering a trademark of their invention. So today, as a company, you've done research and you've been able to come up with a new invention that has not been in the market, something new. Now, what benefits will you be able to get if you decide to register that invention? You decide that, okay, this is our invention. We want to register it with register the trademark so that nobody else will use our trademark or our name there. So you ask about what? You're being asked about basically being asked about the benefits. Number 1 is legal protection, means you are the only person allowed to use that or to use or to produce that item. So basically, the law protects you that nobody can use your item or use your idea. The registered trademark gives the company exclusive rights to use the mark. Somebody has been able to write. Okay, prayer break 105. Okay, good point. 105. Sawa. That is noted. Number 2 is brand recognition. So legal means what? A registered trademark gives the company exclusive rights to use the mark, protecting it from infringement. Number 2 is brand recognition. So it helps establish a unique identity by the marketplace, enabling customers to easily identify and trust the product. So basically, if you register trademark, then people are able to recognize your brand and support you. Then competitive advantage. Trademark creates a barrier for competitors and strengthens the brand position, leads what? Market. So basically, since you're just selling that item, you end up selling more because nobody can be able to produce your item or sell your product without your knowledge or your authority. Then revenue generation, trademark can be licensed or franchise, generating what? Income for the company. So you can use franchise, I can give you a right to use my trademark and then you pay me. Then asset value. So trademark is an intangible asset that adds value to the company, especially during mergers or acquisition. So the trademark that you have sometimes is called intangible assets. If you look at the asset of the company, you have tangible and intangible. One of them is trademark. Another one is you have the trademarks. Another one could be aspect of the goodwill the company has. Those are called what? Intangible assets, and they're very, very important in ensuring that the company first. Then number 6 what is called customer loyalty and trust. Basically, some customers who are available to particular brand. Once you register it, then you have now you are the Sony producing electronics, and basically your customers, once they find that your item is quality, they'll keep on buying from you day in, day out. So basically, those are some of the benefits that a company can accrue by registering a trademark. Well, so we can give time for prayer. Say patents is also one of the intangible asset patents. We have trademark patents and what? We have trademark patents, copyrights. All those ones are basically we call them what? Copyrights. Thank you for that. So let's have a break, and Aziz is also going for prayers. Let's meet here at exactly 1:15. Let's be here by 1:15 because it's going to take 10 minutes prayer from 1:05. So 1:15 this year. Let's have a small break and then come be here by 1:15. Thank you. Can you proceed? Okay, thank you. So this question, this is now August 2022. This was an exam that was done in August 2022. So the first question that they started with here is a very funny question. They are saying that enumerate 7 distinguishing features between projects and programs. So what they're asking you is what? To give differences between a project and a program. So is the project the same as a program? Or there's a difference between, when we talk about I have a project or I have a program, what differentiates them? So basically, that is what we are needed to tackle in this question to be able to what? Differentiate. So what happens here is that we're going to use various aspects or parameters to differentiate. Or if you look at my notes, the way they are put, is a place called the feature that I'm using or the parameter I'm using to differentiate. And then I talk about the project from one side and then the program on one side. So basically, you can use, some of you may prefer to use the table. Somebody may prefer to use what? The paragraph or the prose form where we say that what? For example, in terms of definition, that a project is a temporary, and say that in terms of definition, a project is a temporary unique initiative undertaken to produce a specific output. So that's the definition. Then in terms of programs, a collection of related projects managed in a coordinated way to obtain benefits not available from managing them individually. So a program means what? A number of projects. When your program means what? You're running a number of projects. But now, in exam, somebody may say that you just said that what? You don't look at the difference. Then the number one is what? Difference in terms of definition. That what? A project is a temporary, unique initiative undertaken to produce a specific output. On the other hand, a program is a collection of related projects managed in a coordinated way to obtain benefits not available from managing them individually. So you see, you can decide to use this table or you can decide to use conjunction. Conjunction basically are joining words. So those joining words can be able to help you explain them. So you have point number 1, you explain number 2, number 3, number 4. So with whatever makes you happy, what you go with. Number two is in terms of objective, means we look at what is the objective of the project and the objective of the program. So that's the objective, is that project has a single clearly defined goal. So basically, if you have a project, then it has got a single clearly defined goal, major goal. What about program has broader strategic objectives and multiple goals. So basically, because a program involves so many projects, so you may end up what having, if a program has got 5 projects running in, then basically means what? There are 5 goals in it, so it has got many goals. In terms of duration, talk about a project. In terms of duration, a project has a defined start and end date. That's it. A project is temporary. It has got time for starting the project and the time for ending the project. What about a program? May be ongoing as long as or long term with flexible timeline. So basically, programs are normally what? They don't have definite starting and ending time. And then in terms of scope, scope means area of coverage. What about the project? So projects are narrow and focus on delivering specific output. So a project normally has what? A narrow scope. It is focused on achieving what? A specific output. What about program? Broad and evolves as projects within it are completed. So basically, the program is what? Broad, has got a bigger scope. At the same time, it keeps on evolving, changing as each project is being implemented. Now, in terms of complexity, if you compare complexity of the project and that of the program, then what's the difference? So that project less complex, usually involving fewer tasks and stakeholders, because it's only one. What about program? More complex, involving coordination across what? Multiple projects. So program involves so many projects. So basically, in terms of complex, it's more complex than what? Than a project. Then in terms of management, a project is managed by a project manager. Then what about a program? Overseen by a program manager who coordinates projects, manager. So basically, a project is by project manager, but now a project program manager, and a program manager may be coordinating several project managers. In terms of change adaptability, less flexible to scope change. So basically, a project has got mostly a very defined objective. So basically, it's not just flexible. What about a program? Highly flexible to accommodate what changes across projects to meet what. So basically, you could be able to what use them. So you see 7 marks, but it is a lot of work. In 7 marks, and getting that 7 marks, look at the kind of work you're supposed to do. So professional papers normally are so demanding. Then for you to be able to score more marks, then you have to what work more. The next question here is asking, assess for advantages of functional organization structure to an organization. Basically, a functional organization structure is whereby what you organize your company in form of what? Of departments or sections, marketing department, production department. So you ask about what are some of the advantages of having such kind of what? Of structure. Number one is what? Specialization and expertise. So file structures group employees by similar roles, e.g., finance, marketing, which promotes deep expertise and operational efficiency. Staff become highly skilled, basically. So if you have a marketing department, means what? Those in that department must what? Must be marketers. If you have another production department, those who are expert there must be also. So basically, in this one, you're able to ensure that what? You group people as per their expertise. Number two is clear chain of command. We know who to report to, who is supposed to give us instructions. So as that authority flows vertically, making responsibilities clear. Employees rapport, employees report to one functional manager, reducing confusion in decision making and accountability. So basically, what they're saying that what, for example, if we have a functional area or a functional unit like now, let's talk about marketing department. Then you will have what? Head of marketing department. So in case of there will be no confusion because what? Every individual will be reporting to what? The head of department if you work within that department. So there will not be confusion because what? All of them will follow what? Follow a particular or will work towards what? Achieving a particular objective. Then in terms of another thing is what? Is efficient resource utilization. When you put expert in area of their expertise, then basically they'll be able to what? Use resources what? Effectively. So we say that resources are organized by functions, or by functions what? They are organized by departments or functional areas by the functions, leading to optimal use of equipment. This what they can be able to what use the equipment optimally or use them well optimally. Staff knowledge across similar tasks. And so basically, you will ensure that what that even staff is also a human resource. Basically, staff are called human resource. So with good with this structure, we are able to ensure that what all the staff members can be managed in a very proper manner. Give me a minute. Give me a minute. Yes, we're back. We're looking at advantages of organizational structure and functional, and in the last one, talk about what? Facilitates career growth. When talk about career growth means if you are somebody who has done accounts and you're put in accounting department and you have the necessary skills and equipment and the qualification, then basically if a chance for promotion comes, then basically you consider, you can see yourself moving up the career ladder. That's the best thing with this. So basically with this kind of structure, somebody can see that in this place I can rise to the topmost head of this department, even head of a section or a section department, or even what a unit. So basically, it gives employees a clear career. People will motivate that what in this department, I'm in the right profession, in the right department, and I believe this one, in case a chance comes, I'll be able to what I can be able to be move up the ladder, the career ladder. Very, very important. And then question number 3 is asking, discuss for characteristics of effective control system. So this one is another management function. This is a question that, as we are talked about organizing, you can remember the other paper was talking about organizing function. Now, this paper has gone to this other function, which is called what? Controlling function. So the question is asking us to discuss for characteristics of what? Controlling or effective control system. This is a system of the company. What are some of the what? Some of the characteristics of an effective control system. Number 1 is accuracy and reliability. So the control system must provide correct and dependable data for timely decision making. Inaccurate information can lead to what? Poor performance assessment. So if you have a system that is used to control maybe a budgetary control system, then should be what? Accurate, giving you accurate answers in terms of maybe spendings, in terms of money coming in. So basically, it should be able to what? Give you a very accurate. Number 2 is what? Timeliness. Means what? That system should be able to what? Give information on time or respond to inquiries on time. So control should detect deviations and deliver feedback promptly. Means within no time, within a short time, people should be able to what? Get feedback promptly. The quicker the deviation is not, the quicker the deviation is noticed, the faster corrective action can be taken. So if you're working on a given item, if you, for example, you are talking about financial control, if you identify that there's some money being spent in a proper manner from the system, you can be able to take corrective action very, very urgently. Number 3 is flexibility. The system must adapt to changes in the external and internal environment. So basically, the control mechanisms you have, or the control system that you have, should be able to adapt to the changes that may occur. A rigid control mechanism may become obsolete in a dynamic environment. So that is also very, 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 very important that you understand that perspective very well. Then cost effectiveness. This is very true. This is one of the most important factors that we consider. Basically, a control system should be cost effective. Means what? Should be able to acquiring it and maintaining it. It should be ensure that what? It is cheaper. We can be able to acquire it without spending much money. At the same time, we can be able to what? We can be able to basically. So the benefit of control system must outweigh its costs. Means the amount of money we are spending to manage or control it should outweigh its costs. What does that mean? What that means is very simple, that a control system should be, the benefit of using the system should outweigh the costs or the amount of money we spend. That is basically what that question asks, or that's basically what is being said in that question. So I believe that is well understood. Is there any question on that topic of control system? Any question? Ambuche, Aziz, Nombat, Wendy, any question? Any question? Wendy has no question. Nombat? Aziz? Okay, I don't see anybody. If people don't have a question, so we can proceed. Aziz, thank you for the response. The next question here is asking, one option. Then you cannot say that you're deciding. A decision is made basically when there are more than one option. That's what I want to decide. Means there are A, B, C, and D, or there are A and B. Then I need to look at one that I want to go by. So that's called decision making. Now, see that decision making is the process of selecting the best course of action among several alternatives. So those alternatives are called options. So for you to decide, there must be options that are available. So we look at which one is going to, or which one is the best for me. That's what. Now that's when aspect of what decision comes in here. We'll talk about what? In decision, we talk about what? Talk about the aspect of what? The aspect of the best interest. Or we look at those factors that you have. Which one is the most appropriate? That is when we talk about what aspect of decision making. We look at options that you have, and you choose the best amongst the available option. That is basically when we talk about decision making. Now let's then it continues by saying that it is critical managerial function and exploit opportunities. So that is very, very important, that you must know that in decision making, we must look at the aspect of choosing the best alternative to help us in management. So managers are the ones that normally are given the opportunity, or are given are the ones that are normally given that function of what? Of deciding on the best way forward for the company. So managers normally decide on behalf of the company. That's basically what happens in decision making. Then you continue and look at Roman 2 part of A, or B Roman 2, Roman 2 part of B. And the Roman 2 is saying, summarize 5 steps of the decision-making process. So this is basically asking what? This question is asking about the decision-making process. And there's something I told you before, that if you see a question in the process, you must be very, very careful. And if you're doubting yourself, then basically avoid it, but master the process. But in case you are doubting yourself, then basically don't go for the question, because in a process, if you miss a step, then that is basically where marking stops. For a process, it has to go that is how it's supposed to go, the way the process is supposed to go. If something happens which is against the process, then basically, if something happens which is against the process, then automatically that is where the marking stops. So it's important that we understand that perspective and understand it clearly. The next, so let's look at the process. So how do you go about deciding or making a decision? Number one is problem identification. Because you have to decide, this decision is supposed to help you solve a problem. So it must be an issue why you're deciding. So that issue, problem doesn't mean it's a negative thing. Problem means what? It's you're not decided. So a problem doesn't mean that a problem does not mean that it's something bad. Problem means what? You just not decided. So being undecided is a problem. That's basically, can be good or bad, but basically, so recognize that a problem or opportunity exists and defining it clearly, what you do then. Information gathering. So that for you to decide, you must gather enough information, because you need to make decisions based on the information, not based on any rumor. Decisions need to be made based on the right information which is provided. So that is it. Then so collect relevant data to understand the problem, context, and constraints. Then generating various possible solutions or course of action. So you say that this is the problem we are having. Then the question is, which options do we have to solve the problem? Which are some of the options that we have in place that we can be able to put in place for the problem? You have a problem of customer service. Now, how can you be able to solve the problem of what? Of customer service? And then from that, we can be able to what? From that, we can be able to put in place good mechanisms. Then getting various possible solution to course of action, then evaluating alternatives, so that, okay, these are the options that we can do. We can do A, B, C, D, solve this problem. The question now, let's evaluate them. A is too expensive for us. We cannot do it. So we don't have money. Let's drop A. B, we need some expert we don't have. Now C, we can do. So basically look at every option, look at the merits and the merits, then what? You choose the one that you think is the best for you. Then number 5 is what? Selecting the best alternative and implementing. So you choose the one that you think is the best for you and then put resources in place to implement it. So that is on what? On selecting the best alternative, and then you implement that best alternative. Then the question number 4 is asking, examine 4 types of delegation authority in a company. How do you, or we call them what? Types of delegation. Which are some of the options or types of delegations that we can have as an organization? We call them types of delegation. So the first one is called general delegation. This basically you say that this involves assigning a broad authority to subordinates to carry out a range of duties regularly. For example, branch manager delegates authority over CDD. So basically, this is called general, whereby you tell somebody, ensure that operations in my office are going on well. You don't become specific, you basically go general. Then you have what's called specific delegation. This is whereby I tell you that what this aspect, I give you such that what nataka uangalie. So look at this aspect. So this is when authority assigned for a particular task or project, it is limited in scope and time. For instance, assigning a team leader to oversee a launch of a new product. So this case means what? You are told you're supposed to oversee what? You are supposed to oversee launching of products. So basically, that is called what? That is called formal delegation. No, sorry, specific. Then you have what's called now the formal delegation. Formal means it is official that the work is officially handed to you. That's why it's called official delegation. Now, what is official delegation? So formal is also called official. So this type of delegation is officially documented and part of the organization structure. It is often found in job description and organization. Basically, you're told what to do. So work is so delegated to you. And then number 4 is informal delegation. This is whereby you just tell your friend, stand in for me. So in verbal or coastal delegation of authority based on necessary or mutual understanding without written documents. For example, asking a colleague to what? Present you in a meeting. So go and represent my meeting. Hey, I'm not going to be there, but please represent me in a meeting. Or for example, I'm not going to be there. Can you stand in for me in this lesson? So that's called what? Informal. We don't have to write down he writes, I sign. No, we are friends. So I'm not going to be there. Please, can you stand in for me in this lesson? We'll be able to talk later. Then be part of that question is that with the reference to action change, explain the following. So you see, there's something you need to look at here. This topic of action change is very, very rampant. If you look at, there's no paper that goes without having this change. So each change is a rampant topic. So in a revise, you look at which topics are more rampant in the paper. So we're told to define these two types of change. We have what's called the reactive change and proactive change. So what's reactive change? Reactive change is occurs in response to external pressure or external events such as what? Economic downtime, new regulations, or competitive aggression. These are planned and aims to adapt quickly to the changes. So reactive means you wait until something happens, then react. For example, when a competitor has decreased the price of their goods, you can lose customer. You also by just look at what they're selling it at 50, and I'm selling at 65. Let me also come to 50. Very reactive. That's called reactive change. Then you have what's called the proactive change. Proactive change is initiated by one in anticipation of what? Of future challenge or is deliberate and strategic, aimed at gaining competitive edge or improving process before problem arise. Basically, this is what you plan to change. It's planning to change. Basically, you are being proactive. You can see what's going to happen in future and start changing. That what by the time the future comes, then you are able to what? Ensure that you are able to serve your customers without any problem. That's called proactive change. The next question here is asking, enumerate 3 types of marketing strategies. So we are talking about this one, marketing strategy that we have. Those ones were not basically, we are talking about pricing strategies then, but now these are called what? Marketing strategies. Number 1 is called cost leadership strategy. So focus on becoming the lowest cost producer in the industry to attract price sensitive customers. So this means what? As a company, you minimize the cost of production so that your items become the cheapest. We are not talking about quality here. You don't compromise quality. You just become the cheapest person offering the best quality. You don't compromise quality to be cheap. You offer best quality, but also you are cheaper as compared to others. Then number 2 is called differentiation strategy. You differentiate your products so that they become unique as compared to other people's products. That's called differentiation strategy. Now, what does this strategy involve, or what does this strategy entail? We talk about differentiation strategy. What do we mean by differentiation strategy? So we say that aims at offering unique products or service that stand out from competitors, creating brand loyalty. Means what? You make your items to become unique in terms of quality and packaging, so that nobody confuses your product, but they know that this is the product. So you're able to what? Have what's called the brand image. And then you have what's called the focus strategy. So target a specific market segment or niche, tailoring offerings to meet its unique needs better than competitor. This means what? You say that, okay, me, I want to serve only ladies. I want to only sell ladies products. Then you produce very quality. That's focus. Now somebody, you can say that what? I want only to focus on Nairobi County. So you only serve Nairobi County, but give them the best that you can. So when you focus means what? All resources are put there. So basically able to what? Serve them better as compared to any other marketing strategy. The next question is asking, describe 4 strategic roles of a leader. So as a leader, what are your strategic roles? Which in terms of strategy, what are some of your roles as a leader? In terms of what? Talking about strategic roles. Number 1 is visionary role. You must be able to what? Drive the company to achieve what? A given vision. So as a leader, you have what called what? Visionary role. You need to be visionary. We need to ensure that what? You're able to drive the company to achieving what? A particular vision. So the first one is visionary role. You need to be you need to show has the vision you have for the company. That is called visionary role of manager. Number 2 is The second one is change agents. As a leader, it is your work to ensure that what you're able to implement a change that can help the company move forward. So that one we call them what? We call it. So they drive and manage innovation change, help in innovation what? Adapt to new trends, technologies, and challenges. So basically, you must be able to do that to ensure that what the company is able to move ahead and achieve the objective set. Next one is strategic decision maker. You must make these strategic decisions. That means what? These are decisions that can help the company move ahead. So as a leader also, you must ensure that what? You achieve strategic goals. So let us make long-term decisions regarding resource allocation, market position. So basically, then the last one is what? Culture builder. Means you must be a leader who is able to build a good culture, a culture that can help the company move forward. We call them what? A culture builder. You must be a leader that is able to ensure that what the company culture is achieved. So those are some of the strategic roles of a manager or strategic roles of a leader. Basically, those are some of the strategic roles of a leader. So I think just a minute. We